so welcome everyone to the second day of our Money Market in a New Era of Central Banking conference. So I'm sure that by now everyone had a look at the program already. So I think I don't need to mention how excited I'm about to this presentation and also tomorrow's. And so first, and certainly not least, we are going to begin with a keynote address from Hyun Shin from BIS. So Hyun does not need any introduction, so I'm just going to recall to the audience anyways that he is today the chief economist at the BIS, and that's after a series of prestigious academic positions at Princeton, Oxford, and the LSE. And as such, Hyun works exactly the type of work that we wanted to feature in this conference, because it's always something that's very policy or real-world relevant, and at the same time remains extremely rigorous. So your presentation is going to last, or address going to last for 30 minutes, and then we'll have 10 minutes for questions from the audience. And Hyun, the floor is yours.
Thank you, Quentin. It's a great pleasure to join you, and thank you for the kind invitation, especially with this very distinguished panel. Let me share my slides, see if I hope you can see that. What I thought I would do is just to give you a very broad overview of the way that the financial system has changed after the great financial crisis, and to talk you through some of the events of the last couple of years as a way to plot the course ahead in terms of how we may make the market function better. So here's a very standard flowchart where you have savers on the right-hand side, you have the borrowers on the left-hand side. Think of these boxes as balance sheets, and so the flows go from right to left. So we have the institutional investors on the right-hand side of this diagram. And traditionally, we have focused on the broker-dealers, here now colored in yellow. And typically, they've been mostly bank-affiliated entities, and they have been the primary intermediaries. But one thing that we have seen is that the traditional broker-dealer sector has gradually given way to other parts of the market-based financial system. So here's one way to give you a very quick overview. What I've done here is to go to the flow of funds, and just plot the total assets of three sectors. So we have yellow here being the broker-dealer sector, and everything is normalized to 100 at the beginning of 1990. And we're comparing the broker-dealer sector here with the household sector in red and the non-financial corporate sector here in blue. And you see this dramatic increase in the size of the broker-dealer sector in the lead up to the great financial crisis. But then we saw a very sharp decline as the crisis set in. There was a little bit of a rebound, but it's been pretty much treading water to the extent that for a while the household and corporate sectors were lagging far behind, but now they've pretty much caught up. On the right-hand panel, what you see is the leverage of the broker-dealer sector, defined as the assets over equity. And at the peak, we were looking at a leverage of close to 50, but now that leverage has come right down. Now, if you look at this chart, you were looking at this from the old frame of the broker-dealer sector being the primary intermediaries. You may have thought, well, doesn't this show that the capital markets have been in retreat, because the intermediaries really have shrunk in this way relatively. But I think here, this is where the new infrastructures and the new institutions in the capital markets really come into their own. One of the big changes since the GFC has been the advent of various financial market infrastructures, such as clearinghouses, exchanges, and other platforms. And a lot of the market activity has migrated to those areas. And I think this sets in motion, I think, a discussion about how we should think about financial stability, and in particular, how we should think about systemic risk in a market-based financial system. I think when we have banks, and this was very much in operation during the Great Financial Crisis, defaults were a very important channel through which stress was propagated. And I think what this has given rise to is this picture that you're seeing now. It's a kind of hypothetical case of how systemic risk would propagate. And the idea is that A has borrowed from B and B has borrowed from C. And when A takes a hit, Bank B takes a loss. And if that loss is big enough to eat into the debt claims, then Bank C takes a hit, and so on. So this is the way that we would instinctively write down a systemic risk model as a kind of cascading domino sequence of defaults. But I think this may be the wrong conception when we have primarily a market-based intermediary market-based intermediated capital markets, where the defaults could certainly exacerbate the stress, but it may not be necessary in propagating the stress. And I think this is typified, especially by what happened last March, in that one of the areas where we saw a great deal of stress was in the treasury market itself, where default itself wasn't really an issue. And we have to think about other channels of stress propagation. And let me introduce that topic by taking you through three possible ways of increasing leverage. And let me just go through that in sequence from left to right. The first picture on the left here is a standard MBA textbook idea where you keep the assets fixed. That's why it's in gray. But then you have an equity buyback that's financed with a debt issue. So there's a straight substitution of equity by debt. So you increase leverage that way. In the middle, we have a dividend financed with an asset sale. And so you just shrink the assets and thereby also shrink the equity, but the debt remains fixed. Think of it as long-term debt. And this is the way, for example, the Merton model, which has a long-term debt outstanding, would also model an increase in leverage. It's really the fluctuations in the assets which causes an increase in the leverage. But it turns out that for capital markets, it's this third method, which is this third mode, which is probably the most important. And this is the increase in leverage that comes from a decline in margin. So the idea is that the investor has some own funds, here, equity, marked in gray, and the amount of margin you need to put up to finance the assets you hold then fluctuate. And the equity is only financing the margin. So when the margin declines, you can take on more debt, and so the assets increase accordingly. And so this is an idea where assets and debt sort of move one for one, as it were. And that's exactly what we see if we look at the broker-dealer sector. So this is a chart that I have in a paper with Tobias Adrian. And what it shows is the broker-dealer sector in aggregate. And the horizontal axis is the dollar change in total assets of the sector. And the vertical axis is the dollar change in the debt and also in the equity. And the hollow blue dots here show the relationship between the change in the assets and the change in the debt. And the red diamonds show the change in the assets and the change in the equity. And what you see is that the slope of the blue hollow dots is essentially 1, which is to say, for every dollar change in the assets, you have a dollar change in debt. Whereas the slope of the red line is essentially 0. So change in assets are matched dollar for dollar, but by the change in the debt. And that's exactly what you see on the right-hand panel here. A dollar change in assets is met exactly by a dollar change in the debt. And you see this very sharp deleveraging that we saw in Q4 2008. That was a very large deleveraging in that there was an $800 billion contraction in just one quarter. This is quarterly data. And clearly there was a lot of default then as well, but perhaps the stress was underestimated by the default itself, and the deleveraging also played a very important role. So let me just sketch a very high-level framework that I've been working on, and this is a paper that we're preparing for the Handbook of Financial Markets with my colleague Ciro Aramonte and also my colleague Andreas Schrimpf. And in this paper, we lay out a framework for debt capacity in the sense of trying to formalize the idea that you just saw, where the leverage and debt capacity fluctuate mainly with margining capacity. And the idea is that margins limit the use of debt, and it's the fluctuations in the debt capacity entailed by the margin which entail fluctuations in financial conditions. And the key equation is a kind of budget constraint, which is the middle bullet here, where the margins associated with particular assets that the investor holds, think of YI as the dollar value of asset I, they have to add up to some notion of economic capital. And economic capital is the amount of equity that you're devoting to that particular transaction, to that particular trade, to that particular position. And it's rather like a standard consumer choice problem, where kappa here, which is your economic capital, is your budget constraint, is your budget, and you're allocating your budget according to some criteria. And I'll give you a quick example of how one could analyze this in a second. But the two main propositions that come out of this framework, let me just signpost them at the beginning, and I'll say more about this in the course of this talk. The first proposition is that there is this recursive property of debt capacity, in the sense that debt capacity of one investor is increasing in the debt capacity of other investors. In other words, greater leverage by others enables greater leverage by a particular investor. And that turns out to be something which is very powerful, and quantitatively could be quite a big channel, in particular for the propagation of financial conditions. So when we're in an expansion phase, greater leverage begets greater leverage. But when we're in the contraction phase, where margins increase, we have the spillover that goes from diminished debt capacity of some investors, spilling over to the diminished debt capacity of other investors. And these stresses can propagate with or without default. And I'll give you a case without default in order just to highlight the mechanism. And the second proposition is that the deleveraging that we saw, the deleveraging mechanism that's encapsulated in that first bullet, is very closely related to the so-called dash for cash, where the portfolio composition goes from risky assets to assets that are more cash-like. And what we argue is that these two these two channels of stress propagation are not really separate phenomena, but rather they're two sides of the same coin, in the sense of the reallocation of economic capital. And the intuition is when your budget constraint becomes tighter, you have to reallocate more or less by force from those assets that command a high margin to those assets that command a low margin. And cash commands the lowest margin of all, in that you don't have margin for cash. So let me give you a quick example of a value at risk constraint driven bond investor. Think of a value at risk constraint that takes the form that your economic capital has to cover some alpha times the standard deviation of your portfolio return. And your portfolio is going to affect the sigma. Alpha and kappa, treat them as being constants for now. And I'm going to denote the Y here as your portfolio. Think of these as dollar values. Mu is the vector of expected return over these n assets, and sigma is the covariance matrix. And formally, your maximization problem is the one in below. So you're maximizing expected payoff subject to alpha times the standard deviation of return being no higher than your economic capital. Now, if you solve this, you get the Lagrange multiplier, which is essentially the very familiar SHoF ratio, but in this n-dimensional form. And that makes sense because the SHoF ratio gives a sense of how much additional return you get from relaxing your budget constraint. And here the budget constraint is the economic capital, which enables you to take on greater standard deviation of return. And so it makes sense that the Lagrange multiplier is the SHoF ratio. And when you solve this, you get the optimal portfolio that looks like this on the second line. You're scaling everything by the SHoF ratio. The optimal portfolio is proportional to economic capital. And the all-important object is this inverse of the covariance matrix, which is a very familiar object in portfolio choice. Let me give you a very simple example so that we can get a very nice closed form solution. Let's think of a covariance matrix that looks like this, where C is some positive constant and Z is also some positive constant, but think of Z as being small relative to C. And so what this says is the variance is only slightly higher than the covariance. And as Z goes to 0, we're thinking of the assets as being more and more correlated. So think of the assets as being some portfolio of government bonds that have very, very closely correlated returns. Now, in this case, the inverse takes a very, very simple form. And so we can just plug everything in. We can solve for the optimal portfolio as in the second line. And I draw attention to these red expressions here, which is the Z. Remember where Z comes from. This is the additional size of the variance relative to the covariance. And so what we're going to do is take the limit as Z goes to 0, or at least think of Z being very small as the operating case to give you a sense of how very closely correlated government bond portfolios might actually behave. Now you can see from this expression that as Z goes to 0, the position size just blows up. Now some of the Y's are going to be positive, where on the right-hand side you see that it depends very much on how large the expected return is relative to the other bonds in your portfolio. So some of the bonds are going to be positive, some of the bonds are going to be negative. They're going to be short positions. But in any case, the absolute size of those positions will be magnified as Z becomes very large. So let's just plug in some numbers for the sake of it. Just bear in mind that the correlation row here is just 1 over 1 plus Z. And here's a plot for that particular numerical example. We're just plotting the position size. I should say that the economic capital that we're thinking about here is 1. So think about the position size is essentially giving you leverage here because the economic capital is normalized to 1. And here's the size, long and short, of 2 bonds. Y1 has a slightly higher return than Y2. And so what that means is in this kind of framework, you have a long position in the first bond and a short position in the second bond. And that long-short portfolio is going to be magnified without bound as rho goes to 1. And as we get close to the correlation becoming close to 1, you see this fanning out, this open jaw pattern where you have a very large leverage portfolio. Now, I think this is where the stress dynamics might actually kick in, because when you have a shock and the correlation declines, this has implications for your portfolio as well, because your economic capital constraint binds, and this will entail some adjustment of your portfolio. Now, as is typical in these cases, the adjustment serves precisely to undermine the assumptions that are underpinning the that particular positioning. So here's an example where we start from point A, And there's a slight shock that reduces the positioning. And this slope 1 over h, this is the relationship between, so h is a slope that says for any given amount of sales, how much does that affect rho? So think of, let's say, a standard exponential moving average updating of your covariance. What this would do is this would reduce the measured correlations, and that would entail some portfolio change as well. And that's indicated by this shaded rectangle. But then once you reach point B, you have not really sold enough to be consistent with where you should be, given your economic capital constraint. So what you face is this air pocket between B and B prime. And so I think we have this additional sale, but then at B prime, you're not quite where you want to be either, because now the other relationship is out of kilter. It's only when you've gone from A all the way down to C that you would see something that's consistent within the economic capital constraint. Another way of saying it is if we map the margin, which is given by the reciprocal. So here the Y1, think of it as being leverage because Cato is 1. So we're going from leverage around 25 to leverage which is considerably below. And so that's reflected in the margin as well. So we have an increase in margin from something which is very, very small at point A to something which is quite large at point C. And if we look back to March of last year, and there are some telltale signs that there were these dynamics going on. If we look at the futures market, for example, one of the reasons for looking at the futures market is that a very popular trade that's now been very well documented by some research papers that have appeared over the summer is that typically an investor may hold a portfolio of treasuries, but then that will be hedged by an equivalent position by going short in the futures market. But nevertheless, whether you're long or short, an increase in the margin is going to have an effect on your positioning. So here we see in red how the margins were behaving in the futures market. So we have, compared to the interest rate swap market and the CDS, we have this very sharp increase in the margins on futures. And if we look at the right-hand panel, it was primarily due to the futures margin that were being paid for by the customers. And there have been some very interesting updates to what we saw last year. And let me point to this paper, which I think is a very interesting paper that uses the form PF data published by the SEC, that is collected by the SEC. And what it shows is the hedge fund treasury exposure, both long and short, over these few years. And the blue is the long exposure, the orange is the short exposure. So typically there'd be more long rather than short, because there are many different varieties of strategies. It's around, it's just below 1.5 trillion in terms of total exposure. But they focus attention very much on the so-called cash futures basis trade, which is the idea that you hold a long position in treasuries, but then you hedge by having the equivalent short position in the futures. And you see that this constitutes around, let's say, 2/3 of the total position. If you think about this as being, let's say, just over or 1.3. So we had at the peak something in excess of 750 billion. And what they also give is, I think, some very interesting texture to how these trades were laid on, in that the repo financing for the long positions in blue were not matched by the reverse repos, but rather you see this gap opening up, indicating that a lot of the positions were put on using the using a futures contract, and therefore they were off balance sheet. But then you see this short positioning here on this chart as well. And also, just to put further texture on the infrastructure, we have also seen, I think, a very interesting development where the financing of treasuries has also gone hand in hand with the growing importance of cleared repo, so-called. So here, this is from the OFR website, where if you look at the money market fund assets, and in particular the repo segment, we can actually track, which segment of so which assets we're backing, and we see a growing importance of this black line, which is the repos that were financed through this FICC, the Fixed Income Clearing Corporation. Now, let me just, in conclusion, just lay out an accounting framework just to formalize this a little bit more. So imagine that we have N financial market participants, which we're going to call investors for short, and they're indexed by I, which ranges over 1 to N. And XI is going to be the value of debt, and EI is going to be the value of equity. And there are also some outside assets, outside in the sense that they're not the liabilities of any of the N investors. And in this kind of system perspective, we can think of the portfolio as consisting of inside debt claims, inside equity claims, as well as these outside assets. And here, government bonds would be very much outside assets, in that we're not counting the government here as an intermediary. And we're using this notation. I'll need to go fairly quickly, but this is just notation indicating which proportion of these assets are being held by the respective investor. And we can build a whole taxonomy of the non-bank financial intermediary sector by the nature of the claims. For example, mutual funds would issue equity claims only, whereas hedge funds would issue both equity and debt claims, etc. Now, the accounting proceeds by noting the balance sheet identity, which is the first equation, and then let's bring in the margin constraint. So this is the key relationship, where we're saying the margins that are attached to each of these assets have to be met through your economic capital, kappa, which is no higher than your equity. And if we subtract the second from the first, we can get an upper bound on investor I's margin, debt capacity, in terms of other values in the financial markets. And if we just rearrange this in matrix form and just write it down as a row vector, what we see is we get to this crucial equation, which is the star inequality, which is this recursive relationship that I referred to earlier, that the debt capacity in the system, this row vector X, is related to the debt capacity in the system in this recursive way. And a key relationship and a key quantity here is this matrix delta, which is 1 minus the margin. So this is, think of this as a matrix with entries. It's a diagonal matrix with entries that are close to 1, but less than 1. Think of them as a discount factor, as it were. It's the discount factor that you can use to magnify the debt claims. So when we just write this out, we get this first proposition, which says the debt capacity for investor I is increasing in the debt capacity of the others. So this is the recursive relationship here. And through successive substitution, we have the second line. And here we see this the multiple rounds whereby you can increase leverage by already using leverage positions of the others. And because the delta is less than 1, the norm is less than 1. So the series is well defined. And so we have that relationship in the final line. And so it's when the margins fluctuate that this delta matrix is going to fluctuate. And that has a huge impact, or could have a huge impact, on the debt capacity of the system. So in particular, if the debt capacity were to rise sharply after a very protracted period of very low margins, then this could have a very big effect on the debt capacity of the system as a whole. The other proposition, and it's a very intuitive one once you see the margin constraint, is that given that you have this fixed budget of the economic capital, when the margins increase, it's like in a consumer choice problem, the prices are increasing. So you're forced to substitute away from the high-priced assets to the low-priced assets. And this is another way of saying that when you do the comparative statics, when you have an increase in margins from M to M hat, the new portfolio, which is Y hat, is associated with those assets that previously commanded lower margins. And so in this sense, you're migrating towards those assets that previously had lower margins. I think we saw some elements of this, and let me conclude with a couple of charts just to give you a sense of how these ideas might be applied. If we look at the money market fund sector, what we saw was this bifurcation where we had very large inflows into the government money market funds, but outflows from the prime money market funds, so here in blue. And this was true certainly in the US on the left-hand panel, but also in the dollar-denominated money market funds in Europe as well, where they have slightly different names. So LVNAV are the equivalent of the prime money market funds in the US. And what was interesting was that these redemptions from prime money market funds were larger for the larger investors. So when we divide the investors into large investors and small investors, and this is a couple of charts from the quarterly review that we published in March, we see that the large investors were more prone to these redemptions, and they were redeeming more relative to small investors, more or less irrespective of the underlying liquidity conditions of the assets themselves. And the mutual fund sector was also a sector, as you know, that saw quite a bit of stress. And this is a couple of charts from a recent bulletin that we published. And what it shows is that this dash for cash was also something that we should think about in the mutual funds as well. In that we tend to think about mutual funds only in the context of redemptions, but of course, they can actively manage their asset portfolio as well. The horizontal axis here in these charts indicate the investor flows as a percentage of the net assets. The vertical axis gives you a change in the cash holdings of these mutual funds. And when we look at the bond mutual funds in particular for March, the red dots on the top left-hand quadrant really loom into view. And these are the instances where even as investors were redeeming, the mutual funds were holding more cash than before. In other words, they were increasing their cash holding even as the redemptions were progressing. And the numbers in these charts indicate the number of the mutual funds for each of these categories. And we also saw these redemptions from the Treasury mutual funds as well. So let me conclude with a few lessons. And I think here the time dimension of margins become very important in that as we saw an increase in margins after a protracted period of compressed margins, may actually have a big effect in the financial system. And this is with or without default. And in the case of last March, it was certainly without default. But it does point out that the domino model of systemic risk that we are very used to writing down may not be the correct model. And in particular, it's the pecuniary externalities that may be more important. And it's through these spreads. And this is an example of the divergence between the implicit price of treasuries in the futures market versus the cash price itself. So I think what this shows is that we've had this transition from a broker-dealer driven market to a much richer ecosystem, also with exchanges and platforms and CCPs. But it also, I think, highlights some of the challenges that we have. Traditional intermediaries have ceded ground, but it also means that we have to think about regulation in a different way as well. And there's a very important paper by Metrick and Tarullo, which was published in the Brookings papers in the spring. And their argument is we need to think about this in the systemic context of having more a congruent regulation, where we have this congruence in the cross-section between a mainly bank-based leverage versus the other mix and match type leverage that you can assemble using the other financial market infrastructures. And it's the time dimension of the margins, which is going to be extremely important. And there are very important policy implications also for central bank market operations as well, both for regulation and for market operations. So Quentin, let me stop there.
All right, thank you, Hyun, for this very insightful presentation. So I think maybe we can collect a couple of questions. So I'm going to start with the ones that I already have, which are in the chats. So there are two questions from Ricardo Leopoldo from Agência Estado in Brazil. So let me get to it. So yeah, so the first question is related to the financial stability risk worldwide of these non-banks or shadow banks institutions lacking appropriate regulation. So I think he wants you to comment on that. And then the second question would be on how do you see CBDC as potentially being able to improve financial stability? And here the reasoning is that apparently CBDC may imply that major agents or major banks in the market might have to follow tighter regulatory norms in order to be in the network and buy or sell CBDC. So these are the two questions here, and maybe you can have a couple from the panel now.
Nobody... Should we collect a few, Quentin?
Yeah, we can collect a few. If nobody has one at this stage, I also have two. So I think I see that Sebastian actually has one. So Sebastian, go ahead.
I really like this sort of nuanced view of having more market-based sort of CCPs, providing these intermediation services. I guess my question would be regarding the actual funding of all of these. So it's sort of under my impression that the funding really does need to go through the large broker dealers because, say, cash investors might be more skittish to invest directly with some of these long investors. So do you also think that the structure of money markets have changed and sort of the distribution and the path of funds, how they go from initial borrowers to final lenders? Yeah, thanks. Just that.
Let me add the last one, and then maybe you can comment on all of this. So I was wondering if the conclusion of everything that you just told us wasn't directly that central bank might have a role as a lender of last resort to these shadow banks. I would like you to comment on that.
Absolutely. Thank you, Quentin, and thank you, Sebastian, and the others for those questions. Let me take them in sequence. So on Sebastian's question, I think maybe I can just, it's probably best if I just bring back this slide, where I think what we certainly have seen is that the broker-dealers have given way to to a large extent also to these other infrastructures, and one way that this has been made possible is through the direct investment of, for example, money market funds, you saw a chart earlier where the FICC, the FIC, was also channeling the money market funds through the sponsored repos directly to the Treasury hedge funds as well. I think this is a trend that's certainly going to persist, and I think we have seen growing heft of these financial market infrastructures. And remember why they're there. They were placed there because of the experience of the great financial crisis and the fragility that we saw with the bilateral repo contracts as well. And so they have brought tremendous resiliency to the market. And I think it's quite right that we have a bigger role being played by the financial market infrastructures. But I think it's also true that they also bring sort of new lessons in how we should think about systemic risk as well. And there was just one example that I showed you in terms of the time series of the margins. And Quentin, on your question about the central bank's role, clearly ex post, central bank has a very important role to play. And I think one of the reasons why we saw a comparatively short-lived stress episode last year was precisely because of the very active intervention by the central banks in the financial markets, not only in advanced economies but also in the emerging markets as well. We saw some very unprecedented intervention in the bond market, for example, in the emerging markets as well. They were primarily there for market functioning reasons rather than QE, rather than for monetary policy purposes. But they were really instrumental, I think, in restoring order. On the question about regulation, as you know, the Financial Stability Board and other multilateral institutions, and also at the competent national authorities as well, there is a program of work on the appropriate regulation, and this is something that will continue, and we certainly learned some very important lessons last year. And finally, on the CBDC, I would say that CBDCs, I think, only touch on this issue tangentially. I think there are many more important issues to do with CBDCs that have to do with the greater access, financial inclusion, the greater competition, the efficiency and safety of the system, of the payment system. And I think PIX in Brazil is a shining example of how a publicly provided infrastructure in the payment system can play a very important role in promoting inclusion. And we can think of the PIX case as very similar to what a CBDC would achieve, except that PIX is still with the liabilities of financial intermediaries. But many of the same economic properties would be there with PIX as well.
Thank you, Hyun. So we are almost at the break, but I think most of us don't really need a break. So maybe we can go ahead with the two remaining questions, if you don't mind.
Sure.
So Adrian.
Yeah, so it looks like if we move away from financial stress with default to this pecuniary in externalities, like the default cost and the welfare cost of this crisis are almost minimized. In some sense, I see that I agree that this amplification mechanism through this pecuniary is externality, but the fact that we don't see any default almost signals that the financial system has the balance sheet elasticity to absorb and react to this huge financial stress that we saw during the COVID crisis. So I almost see that as being a positive.
Okay. Quentin, shall I answer that?
Yeah, maybe you can take the last question from Monika.
Okay,
and then,
sure.
So we've done everything. Thank you.
I thought it's a great framework to think about these market players who have to basically almost arbitrage in assets that are very similar to each other and then take on extreme positions. And so they're playing an important role. And so I was wondering how you think about the equity that is employed in each of these sectors over time, basically the dynamics of the capas. Is that something that we should think of as regulation is determining the capas, or is this something that these entities bring into the market themselves, or how do you think about it?
Yeah. So Monika, let me take your question first. I think as you saw in that simple example, the size of the positions is proportional to the kappa. And so the greater the kappa, the larger the positions. And I think there is a very important role for these long-short players in the sense that if they're the counterparty in the futures market to asset managers that are holding duration through the futures contract, then there has to be a counterparty. And in a way, some of the authors have described this as the hedge funds playing a warehousing role for the treasuries by taking on these short futures positions. And given the size of the market, I think that that could be a very important role. I think the important thing is how large are the margins in this case, because that determines the degree of leverage and the extent of the externality. So I think if we can think about the margins and the time dimension of those margins, I think that's probably the most promising way to think about how we can have these markets functioning with fewer of these air pockets going on. And this leads to Adrian's question, which is what is ultimately the welfare cost of these pecuniary externalities? And I think there it's actually quite a sort of subtle question, because we don't actually map out these credit losses as we do in a banking crisis. We cannot map out directly the GDP costs or the fiscal costs of banking rescues. So I think we need to think further about how we can quantify these welfare costs. Now, one important issue which we probably haven't thought about in the financial stability context is what are some of the monetary policy implications of financial stability? In that, if the financial stability in the government bond market leads to fluctuations in very sharp fluctuations in long-term bond yields, and bond yield dynamics are somehow influenced by that, it could have an effect on the conduct of monetary policy as well, in that the kind of signals that the central bank extracts would also be affected. So I think there are some very broad issues about what are the ultimate welfare costs, and I guess the answer to that question depends on how far the initial shock is allowed to propagate within the system, because in that sense, the corporate bond market, for example, or other credit markets, may be affected if you're not there in time to smooth out these fluctuations. But then there is a kind of ex ante problem. If you intervene ex post, what effect will that have on the ex ante positioning and the ex ante margins, and therefore the potential for these air pockets?
Thank you, Hyun. So I think we are right on time to move to the second keynote by Monika Piazzesi. And here again, Monika does not need an introduction. So rather, I'm simply going to mention something that might be interesting for some of the audience, which is that, or maybe some people have missed, which is that Monika, along with Martin Schneider, have worked last couple of years on taking seriously the implementation side of monetary policy and the payment plumbings, and putting it in macroeconomic model. So if you haven't had the time, or if you didn't know, I strongly suggest that you have a look at this. This is very interesting. And today she will address another topic that is arguably probably even more important, how unconventional is green monetary policy. And so Monika, I look forward to your address, and the floor is yours.
Thank you very much, Quentin, for your kind introduction. Let me fix this first. So this is joint work with Melina Papuzzi at the ECB and Martin Schneider at Stanford. In the current low interest rate environment, the main tool for central bank has been unconventional monetary policy. So central banks have been buying assets. They've been buying government bonds traditionally. But more recently, they've also been buying mortgage-backed securities, other assets, and now corporate bonds. And so the goal of these actions is to lower firms' cost of capital and stimulate investment. And so that raises the question, which corporate bonds should central banks buy? The conventional view on this is that monetary policy should aim for market neutrality. So the reason is that central banks don't have a mandate to favor particular firms with their monetary policy. So for example, there's no mandate to favor green investment. And so central banks have been trying to conduct monetary policy in a way that is neutral towards the market. And in practice, this has meant that central banks have been buying bonds proportional to the amount of bonds outstanding. In this paper, we ask what are market neutral asset purchases? So if you had to answer the question to a central bank, what should they do if they actually wanted to be market neutral? What should they be buying? And in particular, is what the ECB currently doing, is that market neutral? Another question that arises in this context is what is optimal? What should they be buying just from an optimal perspective in a world where you have financial frictions and climate externalities? So these are the questions that we're trying to address in this paper. First, we look at data. We want to know what is the ECB currently doing? And so here we measure ECB holdings. We measure the amount of securities outstanding of different corporations. And then we measure emissions by sector. And then we benchmark these holdings of the ECB with the market portfolio. So this is basically the market portfolio firm value. Think of this as equity plus debt. So total firm value. And so that is a measure of capital shares by sector. And so you can compare what the ECB is holding to what the market looks like. And so here we find that the ECB portfolio looks like sector shares of emissions. It doesn't look like the market portfolio. And in particular, the ECB overweighs dirty industries relative to the market portfolio. The portfolio composition of the ECB reflects its implementation of market neutrality. It's because the ECB buys proportional to bonds outstanding. It ends up with a portfolio that looks dirtier. The reason is that dirty sectors issue relatively more bonds. And so the question arises is, are these dirty asset purchases market neutral? Are they optimal? Is this what the ECB should be doing? Or should these purchases be greener? And so for that, we need a model. We need a model to answer the question of what is neutral and what's optimal. And so there we write down a growth model with heterogeneous firms. The model has climate externalities and financial frictions. And so here in this model, firms differ by how risky they are and by how much they emit, so their emission intensity. And then asset purchases by central banks work through return premia. The effect of these purchases differ across firms. There is first a direct effect of asset purchases, which is to lower the cost of capital of firms. And there's also an indirect effect, which is that the purchase program creates more safe government debt because you're buying all these corporate bonds and you somehow have to finance these purchases. So you create more safe government debt, in particular more reserves. That lowers return premia for many assets. And that channel benefits risky firms more. So this is a general equilibrium effect, which is indirect because it's lowering return premia on lots of different assets. In this framework, you can think of what would be a market neutral policy. So if you had to tell central banks what they should be doing to be market neutral, is you would say, you conduct your policy in a way that leaves relative cost of capital unchanged. So that would be market neutral. You can only have with your policy macro effects. So you can lower, let's say, the cost of capital for everyone in the same way, but you're not distorting the market portfolio. And so these purchases would have to underweigh risky firms to offset the GE effect that benefits mostly risky firms. In this sense, the current ECB portfolio is not neutral because it favors dirty firms that we know are more risky because there's a lot of empirical work that documents pollution premia, the fact that firms that have higher emissions have to pay higher returns to their investors. And so a market neutral policy would undo this G effect and underweigh risky firms. What would the optimal monetary policy do? Well, optimal policy, if you put a planner into this model, what the planner would do is design a carbon tax and also design an asset purchase program where the asset purchase program would address financial frictions. And so it would favor risky firms. The financial frictions are strongest for them. It raises their cost of capital the most. And so you would address with your asset purchase program these financial frictions for risky firms. And so that would favor risky firms. And so the question then becomes, what would you do in the current world where we don't have a carbon tax? Then it may actually be beneficial to favor green firms because that's a channel through which you can address these climate externalities. Let me first show you what the ECB is currently doing in the data. So what we do is we measure the ECB portfolio by sector. So we start with the ECB security holding statistics on purchases of individual bonds. So this is confidential data on ECB holdings. And we merge these holdings to the ECB centralized security database on bonds outstanding of different firms. How many bonds do they have outstanding in Europe? And so what's really important in this work is to take care of special purpose entities. So if you look at the raw data on ECB holdings, you'll find that bonds by firms in the finance sector are the vast majority of ECB holdings. So they are 56% of the ECB portfolio. It's just companies in the finance sector. And you know that that can't be true because these firms are ineligible for the corporate bond purchase program. So you know something is wrong if you just look at the raw data. And so how is this possible that the ECB portfolio is made out of many holdings in the finance sector? The reason is that the ECB buys bonds from companies, for example, like Royal Dutch Shell, which is an oil manufacturer. And when Royal Dutch Shell issues bonds, they're issued through Shell International Finance BV, which is a finance company. It belongs to the if you look up in Bloomberg which sector this company belongs to, it belongs to the finance sector. And so it issues the bonds for Royal Dutch Shell. And so what you have to do in order to attribute ECB holdings to various sectors in the economy is you have to research every single special purpose entity and attribute the bonds to the right sector. And if you do that, you reduce bonds from the finance sector to 11%. You can't go much further than that because there is a number of financial companies that issue for many different companies. And so it's difficult to attribute these bonds to a particular sector. So from now on, I'm just going to leave out these 11%. And I'm going to show you results for the non-financial sector only. In the paper, we look at 3 different measures of the market portfolio by sector. One is capital income. So that's one measure of how big a sector is relative to others. Another is book assets from Orbis. And a third is, ideally, you would want the market value of firms in each sector. So this is market value of equity plus market value of bonds. But you can only do this for public companies in Orbis. So that's our third measure, is you take all the public companies in a sector and you measure their market value. Fortunately, no matter what measure of the market portfolio you use, you end up with the same result. So here in the talk, I'm only going to show you capital income, but in the paper, you see all 3 measures and they basically give you the same results. So here is market shares by sector. So on the horizontal axis, you see shares of the sectors in total. And you see on the vertical axis, the various sectors, agriculture, automobile sector. Then there's a large manufacturing sector that we split up into what we call dirty manufacturing, which are subsectors of manufacturing that have very high emissions. This is oil and coke, chemicals, basic metals, and non-metallic minerals. And then we have other manufacturing. So these are the other subsectors in manufacturing. Then we have utilities, transportation, and services. And so what you see is that these red bars are the market shares. And so what you see is that the European economy is an advanced economy in which the service sector is the largest sector of the economy, and the other sectors are smaller, like agriculture and automobiles. Now I can show you the ECB portfolio. That's the blue bars. This is what the ECB holds of the various sectors. And so what you see is that the ECB doesn't hold agricultural bonds. It holds more automobiles and then even more dirty manufacturing bonds, utilities, transportation, other manufacturing, and then it doesn't hold a lot of service bonds, so bonds issued by the service sector. Let me compare these red bars, the market portfolio, and the blue, which is the ECB, what the ECB holds, with emissions. So these are direct emissions of each sector. So these are carbon emissions of the various sectors in gray. And so what you see is that what the ECB does in its portfolio, it's overweighing sectors that have relatively more emissions, like dirty manufacturing, utilities, transportation, and other manufacturing. And it's underweighing services, which is a relatively clean sector, but the ECB doesn't hold many bonds of the service sector. Okay, so this is basically the main result, and you can do this in different ways of constructing these market shares, the red bars. The result is always the same, that the ECB overweighs dirty manufacturing, utilities, and transportation, and underweighs services. And so the ECB portfolio looks more like sector shares of emissions, and it doesn't look like the market portfolio. And the reason, so if you ask why would the ECB buy a portfolio that looks more like emissions instead of the market portfolio, is because the ECB buys proportionally to bonds outstanding. That's their way of implementing their goal of being market neutral. And it's not due to eligibility criteria. It's really due to just buying proportionally. So let me show you how this works. Here in this graph, you have again shares. The red is market shares of the various sector in total. And then the darker red is how many bonds there are of each sector, how many bonds outstanding. And so what you see is that dirty manufacturing, utilities, and transportation, they just have more bonds outstanding than the service sector. So if your eye now compares the blue ECB holdings with the darker red lines, basically what the ECB is doing is it's buying proportionately to bonds outstanding. And so if you look at the purple bar, that's how many bonds there are eligible of each sector for the ECB to buy. And so what you see is that eligibility is not the problem. The ECB is just buying what's out there in terms of bonds. And that what makes it end up with a dirty portfolio. And so that raises the question is, if you had to tell central banks what bonds to buy, what would you say? What should they be buying in order for them to stay market neutral? And so here is a model to think about this question, and also to think about what's optimal for central banks to do. And so this is a growth model with climate externalities and financial frictions. So there's a representative agent with preferences over a final consumption good, C, that inelastically supplies 1 unit of labor. And this final good that households are consuming is made out of N intermediate goods. These are the little YNs. They're produced by different firms. And so here you see a Cobb-Douglas aggregate that makes the final good out of these N intermediate goods. And the intermediate goods are produced by different firms. And these different firms, they experience climate externalities in production. So the way we capture this is we say, they have TFP, they have productivity in their production function, which depends on a climate index, which let's call it temperature, ADA. And so temperature, eta, is what summarizes the quality of the environment. And so this is much like in integrated assessment models by Nordhaus. There's an index that describes how the environment is doing. That's our eta. And then production by these firms increases temperature because you have emission intensities, epsilon, these epsilons, they multiply how much each firm is producing. And so the cumulative amount of emissions is what raises temperature. And so what you see here is this unit root dynamics of temperature. Temperature is today is temperature yesterday plus new emissions. And so this is how production raises emissions and then raises temperature. And that's bad for productivity, Z. Okay, so we have these climate externalities. And on top of that, we need financial frictions to be thinking about quantitative easing or corporate bond purchase programs. And so here we're saying there are two technologies for households to hold capital of firms. There are holdings of capital through a public technology, so that's the K-wiggle. And there's also holdings of capital through a private technology, that's K. Both technologies come with balance sheet costs. So they involve costs, which we describe with cost functions, H, wiggle, and H. These are just resource costs in terms of the final good. They're increasing in how much capital households are holding. They're quasi-convex, which captures a notion of diversification benefits. And they are homogeneous of degree 1. So the more capital you hold, the higher are these balance sheet costs. And these private holding costs, the H, also depends on holdings of government debt, DT. And so what's the interpretation of these balance sheet costs? They capture that risky investments are costly. Some of them don't pan out. In that case, resources are gone. Holding more capital is riskier. It's associated with more costs. And overall risk depends also on holdings of safe government debt, DT. So this is what, these are our financial frictions. And so how do they show up in how this production technology is decentralized? So you have private intermediaries. They invest in capital using a private technology or government bonds. They're owned by households. So these are not agents, they're corporations. They are competitive firms that are owned by households, and they maximize shareholder value. So they buy capital and government bonds, DT, capital in the various sectors, then they get returns on these investments. So return on capital and returns on government bonds, but they also face these balance sheet costs, H. And so how do their optimization first order conditions look like? The first order conditions say the return on capital in sector N or in firm N is weighted by the pricing kernel of households, because these are the shareholders of these private intermediaries. And that's equal to 1 plus the marginal holding costs of capital in sector N or in firm N. And so you see this marginal holding cost on the right-hand side here. It's the derivative of the H function with respect to capital in sector N or in firm N. And so this is literally a derivative of capital holdings. So imagine K is a whole vector of capital in the various firms. And so here you're looking at the derivative of costs with respect to holding more capital in firm N. And so this is a return premium over the short rate. How do you see that? It's because if you look at the Euler equation that households have for safe investments, that's the RS, that's the short rate. That is just your typical Euler equation. That's equal to 1. It's pricing kernel times the short rate is equal to 1, where the pricing kernel is just the marginal rate of substitution between today and tomorrow. Then you see that this marginal holding cost is literally the return premium over the risk-free rate. So this is a financial friction. And so that firms face. So what do firms do? So they produce intermediate goods. They issue claims to capital income. They pay a cost of capital, RN. They hire labor at a wage W. They sell goods at prices, PN, in competitive markets. and they pay a carbon tax tau. If the government imposes a carbon tax, they have to pay a tax tau per unit of emissions. And so they maximize profits. And so how do profits look like? It's revenues minus the carbon tax, minus what they pay for inputs. And what they pay for inputs is labor costs, and then the cost of capital. And so what you see here is that this RN affects how costly it is for these firms to hold capital. And the final good firms, they just buy intermediate goods at price PN, and then they sell the final good at price 1. And so how do these first order conditions for these firms look like, these intermediate good firms? It looks standard. It's basically marginal product of capital minus the carbon tax, which is equal to the cost of capital. But now we know that because the intermediaries hold the capital, that contains this return premium. And so what firms face is a cost of capital that contains this return premium. And so how does the equilibrium look like? The government picks asset holdings, K wiggle, it issues debt. So this is the sum of all capital holdings that the government holds, that's equal to debt by the government. And then it satisfies a government budget constraint. So the government essentially buys capital in the various firms, it issues debt, it has to pay interest on debt holdings, then it raises this the carbon tax, tau. And so to the extent that the government makes money by getting returns on asset holdings and the carbon tax, it just rebates them to households lump sum. So this is basically a version of the Baker-Schultz plan, is do a carbon tax and just revert it back lump sum to households. And then agents optimize and markets clear. So in the following, it's going to be useful to think of shares here. Everything here in this model is going to be constant returns to scale that these firms and intermediaries do. So it's good to think about what is the share of each firm in the total capital stock KT. So that's my kappa. These are the capital shares. So basically, this is the analog of what I was showing you earlier, the red bars. These are the market shares. It's the total claim to capital. It's the market value of the firm. And then the central bank holds shares of capital. That's the kappa wiggle. And it does that with a debt share, which is total government debt, DT, over the capital stock. And the private intermediaries just hold the rest. So they hold the capital shares minus what the government holds. So let me first think about a frictionless world. So what if there were no financial frictions? What would happen in this model? In this model, basically, firms would equate the marginal product of their capital to the cost of capital, and that would be equal to the safe rate. No financial frictions, there are no return premia. And so what the market portfolio, what these kappas solve, is they just equate marginal products across firms. And so what you see is if the right-hand side is the same for all firms, on the left-hand side, what the market share solves is it's just reflecting technology and preferences. So the alphas and the gammas, which are just technology parameters, that's what they reflect. And so in this frictionless world, Modigliani, Miller, and Ricardian equivalence hold. So here, asset purchases are irrelevant for investment and the climate because whatever the government does is undone by the private sector. You get the same market shares kappa. And so here, let me say that you read on the blogosphere by economists that financial frictions don't matter. So many economists think that financial frictions don't exist, and so they don't matter. But it's really important that central banks be market neutral. And so these two views in the setup don't make any sense together, because in a frictionless world, it doesn't really matter what central banks are doing. They can buy whatever they want, and you get the same market shares kappa, because the kappas, they just reflect technology and preferences. So you can't have these two views in the same person. So let me now show you the equilibrium with financial friction. So with financial frictions, the marginal product of capital gets equated to the cost of capital. And so that reflects marginal holding costs. So now the market portfolio reflects these holding costs. And firms with higher marginal holding costs, so firms that have a higher right-hand side here, they pay a higher premium over the short rate. They do less investment. So you see the kappa of these firms, which is in the denominator, is lower if they have higher marginal holding costs. And now you see that because of the properties of H that I assumed earlier, I can write this not just in capital holdings and holdings of government debt, but in terms of shares. So this is how much capital the intermediaries hold. It's kappa minus kappa wiggle times delta. It's how much capital intermediaries hold of each firm and how much government debt they hold. And so by changing government policy, you directly affect marginal costs and therefore financial frictions. And so how would this look like? How could you direct capital into a specific firm or sector? Is basically look at the left-hand side, which equates the demand. Basically, it's a measure of the demand for capital, which is inverse to the cost of capital. So you demand more capital if your cost is lower. And on the right-hand side, you have the supply of capital. This is what intermediaries are supplying. And so you can think of this as just in a simple demand and supply diagram. On the horizontal axis, you have the capital share of a firm in the economy. On the vertical axis, you have the cost of capital. And so you start from an original equilibrium where you have some supply, which is the right-hand side of this equation, and the demand. And now the government can increase its weight on a particular firm, kappa wiggle n. So it increases the weight on a particular firm and it lowers some other capital weights on other firms. And I'm doing a policy that keeps the total amount of government debt unchanged. And so by doing that, what you do is you increase the supply of capital for this firm, and that increases the capital share of that firm and it lowers their return. And so in this framework now, government policy is not neutral, is not necessarily neutral. It can affect the allocation of capital to a firm or a sector. And so the question is, how would you do this in a way that is market neutral? And so let me first make a bunch of comments on the setup that I just showed you. So one is about the role of the central bank. So what I showed you is a real model where we focus on how central bank policy affects risk premium and investment. It's not about price stability. That's because we've done earlier work where we saw that with flexible prices, you get similar effects in a nominal model. So not much changes if you study a nominal version of this setup. And also because investment is about the medium run. So we've seen a decade of large central bank balance sheet. And so to think about investment, we really have to think about the medium run, how these lower returns that we get from central bank interventions affect investment over the medium run. And so at these frequencies, price stickiness is no longer the relevant friction. So you're really thinking about a world with flexible prices. And so this is what I've shown you. In terms of these balance sheet costs, the setup captures the familiar theme from the literature, which is QE stimulates the economy when the government is better able to commit to repay than the private sector. And so this is a theme that is reflected in a lot of work, including people who are in the audience, where this is going on is the government does QE and then affects investment through balance sheets of intermediaries. The new element here is that you have heterogeneous firms. And so these firms have different frictions that are described by these holding costs. And so firm level risk premia are affected. And so we need to know how purchases of corporate bonds, but also conventional policy, how that affects these risk premia that firms face, and they face different premia. We have an extension of this setup to endogenous firm leverage. So here in the setup that I've shown you, the central bank buys claims to capital, but our new version of this setup has the central bank only buying bonds, not equity, and that has effects on liquidity and risk premia. So if you check my website in 2 weeks, you're going to see this new version of the model with endogenous firm leverage, but it essentially works exactly the same way. Here, there's an interaction between climate externalities and financial friction. So you would think the evidence that we have about pollution premia, you would think that the parameters of this holding cost function H will vary with emission intensities epsilon. And so the two features of this model are not independent. Firms with higher emission intensities face stronger frictions. And so how would you think about a market neutral policy? In this setup, quite naturally, you would say, if you had to tell a central bank how to be market neutral, you would tell them, just leave relative returns unchanged. So how the return on the cost of capital of one firm N to the other firm M, that ratio has to stay unchanged. And so if you start from a laissez-faire equilibrium with no government intervention, then you do a comparative static to an equilibrium with the government, then market neutral means you get the same market portfolio kappa in the new equilibrium with a policy. And so the question then is, what do you have to do in order to get the same market portfolio kappa? You can already see if H, the holding cost function, is separable in capital and government debt, then a neutral policy would be to buy proportional to the market shares of the various companies. So your ECB portfolio would reflect market share, but not bond market shares, but total market shares. Okay, so that would be market neutral. So this is a very special financial system in which government debt doesn't lower risk premium. So this is not the type of model that most of us would think is relevant for unconventional monetary policy. The more relevant model has market neutral policies that don't look like the market portfolio. The reason is because any purchase lowers risk premium, and that benefits risky firms the most. So if you want to be market neutral, you would have to tell central banks to underweigh risky firms, because there's this general equilibrium effect that will lower risk premium for all firms. And so you have to underweigh risky firms to offset this beneficial GE effect. What would be optimal? Optimal is to choose a carbon tax and an asset purchase program. The purchase program would be independent of the climate externality. You would take the carbon tax to fix the climate externality. So this is the principle of targeting in public finance. You use the policy that fixes this most directly, which is the carbon tax. And then the asset purchase program just thinks about financial frictions. And so what is the equation that a planner would have in mind? The planner would equate marginal private holding costs of firm capital to the government holding costs, plus the effect of doing a purchase program on intermediaries. So that's this term in green on the right-hand side. That's just the effect of doing the policy and thereby affecting the portfolio of private intermediaries, which then affects their risk premium. And so the optimal policy equates these all. And so how this exactly looks like depends on these holding costs. If, for example, the government has the same holding costs across different sectors, what the government would do is equate all financial frictions across different firms, and that would lower premium for risky sectors the most. And so in this sense, optimal policy would not be neutral, because you would be fixing the financial frictions where they are the strongest. And so for this policy, for an optimal policy to be neutral, that is really a knife-edge condition, which is unlikely that this is going on in practice. So let me summarize what I have shown you. I've shown you empirical evidence that the ECB portfolio looks like the sector shares of emission. It doesn't look like the market portfolio. The ECB overweighs dirty sectors relative to their market shares. In terms of thinking about market neutrality, you would naturally define it as not changing the relative cost of capital. Otherwise, you destroyed the market portfolio. And holding bonds in proportion to the amount of bonds outstanding is not a simple recipe for having neutrality. And instead, the ECB currently favors risky and bond-levered firms. So firms that have a lot of emissions, have pollution premia. In that sense, they're very risky. They also have a lot of tangible assets, so they can issue a lot of bonds, and that's why the ECB buys a lot of them. With a carbon tax, what's optimal would be to address financial frictions. And so here you would favor risky firms because they're mostly affected by the financial frictions. But we don't have a carbon tax. And so then you can think of directing investments towards greener companies. And that would be, from the point of view of this model, beneficial, is having a greener monetary policy.
Thank you, Monika. That's very insightful, a lot of food for thought. So I think we can open up for questions. So I also would like to remind that anyone can ask questions, not only from panelists, but also the attendees. So I think George was first. It was very close, but please go ahead.
Yes, thanks. I really enjoyed and was impressed by this paper, Monika. I didn't know how you were going to square the circle, starting with the difference between the sector shares and the ECB portfolio shares and your theory, but somehow you more or less did. But that raised a question in my mind. If I understand correctly, it would be approximately optimal, or wouldn't it, for the ECB's bond portfolio to actually reflect the shares in that portfolio to actually reflect the sizes of the different sectors, or the shares of those sectors of the total market. Is that not correct? Or do you have any sense of how reasonable an approximation it might be?
So it would not be neutral and not be optimal. And so this is what we think is interesting, is that if you just ask yourself the simple question, what would you tell the ECB that they should be doing to be market neutral? It's not to buy the market portfolio, so it would not look like the market. And so why not? It's because of this indirect effect on risk premia. So whenever central banks conduct monetary policy, and this is in the context of this corporate bond purchase program, but much more generally, any monetary policy affects risk premia. And because some firms have higher risk premia than others, any policy might affect firms differently. And so you're going to do favoritism. And so this is what we're trying to point out with this paper, is you have to look exactly at which firms you're favoring by doing your policy. And because risk premia are the largest for the, or financial frictions are the strongest for riskier firms, what you would have to do to be market neutral is to buy less of risky firms. And so it would not look like the market portfolio, which is something that you would think, but you would underweigh these risky firms. The only world in which buying the market portfolio would be neutral is if the investors who hold claims to firms do not hold government bonds. So if those two markets are totally segmented, then there is no way of your corporate bond purchase program to affect risk premia more generally. But if you do, which is the world that most of us think about, is that central banks come in and they lower risk premia. In such a world, you would not buy the market portfolio because you're benefiting disproportionately risky firms.
Let me just, for clarification, Monika, I understand that the market portfolio is not right, and that's what the ECB is buying now, right? Or more or less.
Bond market, yes, the bond market portfolios.
But yes, you're saying it wouldn't even represent it wouldn't look much like the shares of the different sectors as a portion of the whole economy. Exactly. So on your bar chart, you'd have yet another set of bars that are the optimal allocation. Yes. And that's what I'm curious about, whether they would whether that would be even smaller, for example, for the dirty industries.
Yes, yes, exactly.
Okay,
even smaller. Your intuition is exactly right. It would hold a lot more bonds in the service sector because that's a sector that is relatively safe and has, in terms of not having pollution premia. And so you would put a higher weight on the service sector, exactly. And so it's a very interesting question, is to ask how exactly, what are the numbers that you would tell the ECB? Right now, we can only say just qualitatively, it goes the other way. What they're currently doing is totally wrong. They would have to go the other way, exactly. It's your intuition. Yeah.
It would actually be quite interesting to use your framework to get a quantification here, I guess.
Yeah.
So we are actually running out of time, but I certainly don't want to cut short the discussion. So we are officially starting the 5-minute break, but maybe Stefan can ask his question. And then there's another question from Will Monroe from the attendee. So let's try to squeeze these two in the 5 minutes now.
I just had, so I guess what's going on is that you've got this world where so we've got the private sector with these balance sheet costs, and I guess looks like the government doesn't have balance sheet costs, and then we're kind of balancing that against these externalities in different sectors. So
it does. So the government does have its own balance sheet cost. That was the H wiggle. So, so everything. So I'm not saying it's free for central banks to buy these assets. I'm not at all saying that. And so I think this is where you're coming from.
Yeah. So you're thinking of this kind of, well, if here's central bank, and if you're going to do this, if you're going to have this policy, what's the best way to do it?
Exactly.
And of course, there are all these other issues to do that, that people worry about. And well, one would be, I guess, that somebody might take a position that, well, I don't know, that these asset purchases don't matter that much, and therefore this, here's the central bank trying to do something, it'll have little effect, or else the other position might be that, that it has a big effect, but now this introduces all these political economy issues.
Exactly.
And people want to, people start lobbying the central bank, to favor their sector for whatever reason. Yeah.
Exactly. So I'm exactly with you. We're not taking a stance as to whether these effects are big or small. We're just saying, if you don't believe in these effects, if you think that central banks have no effect, then it doesn't really matter what they're buying, because it doesn't have an effect anyway. So let them buy whatever they want to buy, it doesn't matter. But if it does have an effect, and I haven't quite made up my own mind about this, of how big these effects are, but if they have an effect, then we really have to pay attention to what they're buying, because then they're favoring certain firms over others. And then we have to be very careful as to whether they are basically financing the wrong firms. So, right, and so this was the point of the empirical exercises. We wanted to know, whom are they currently favoring? They have a huge portfolio. The ECB has a huge corporate bond portfolio. They are now the largest investor in new bond issuance of these corporations. So they're big player. And so the question is, if it does matter what they're doing, whom are they currently favoring? And so that picture is basically clear. Is they're favoring, if you want, the wrong firms.
So Will Monroe had the last question, but we only have 2 minutes, so if you can make it quick, it would be wonderful.
Sure. Can you hear me?
Yes.
So I guess this idea of kind of risk neutrality in asset purchases, I think, is particularly interesting. And I was just trying to think a little bit more about what some of the kind of side effects might be if we start thinking about kind of risk neutrality from a broader perspective than just environmental risk. And so, for example, we think quantitative easing lowers risk premia for risky firms, that prevents them from going into bankruptcy, and perhaps this kind of helping risky firms independent of the kind of carbon risk dimension, maybe that's an important part of the efficacy of monetary policy. And so how might we trade this off in terms of kind of broader risk and policy efficacy versus kind of carbon risk more specifically?
Yes, exactly. So you would have to take a stance, a quantitative stance as to how large the climate component of the risk is, as opposed to other types of risk, and they are exactly, you have inefficiencies coming from bankruptcies, and so the central bank can play an important role, and has been playing in Europe, an important role in trying to minimize these financial frictions, let me broadly speaking, that have to do with risk in the financial system. And so with interventions, you can, this is a framework that even if you take out the climate externalities, for me, this is a framework to think about which firms monetary policy are affecting. And so just as we think about monetary policy affecting different households differently, I want to think about how does monetary policy affect different firms, and some of them have more bankruptcy risk and therefore face more deadweight costs in bankruptcy. And so the central bank can play a role in this. And so the framework helps you think about exactly these trade-offs and helps you think about what's optimal and what's neutral in such a world.
Great, thanks.
Thank you, Monika. So there were two other questions that we won't have the time to address now. So maybe hopefully we can do it. So at the end of this day, we'll have a bit of time to prolong the discussion potentially. I don't know if Monika will be here, but some will definitely. So feel free to join us at this point in time. So now we are going to move to the panel session, and I let Izabella take over.
Hi everyone, I hope you can all hear me. Yes, so for those who don't know, I'm Izabella Kaminska. I'm the editor of FT Alphaville, the Financial Times Markets and Finance blog, and I'm really excited to introduce what I think is going to be a very exciting panel on the lender of last resort function and how it is changing and evolving. They've brought together a really excellent, troupe of names, some of the most respected names, I'd say, in the field of money market studies and central bank operations. So I'll quickly just introduce you because I think it's such a big discussion. We'll crack on immediately. So we've got George Selgin, who is the director of the Center for Monetary and Financial Alternatives at the Cato Institute, joining us, and he is also an occasional and vocal critic of the centralists out there on Twitter and on social media, but a very much welcome critic, I would say. I have always found your commentary fascinating and insightful. Perry Mehrling joins us. He's a professor of international political economy at the Pardee School of Global Studies at Boston University, and a uniquely informed observer, I would say, from a practitioner's perspective on the developments of money markets. And he's also the author of a new book, The New Lombard Street, How the Fed Became the Dealer of Last Resort. And last but not least, we're really grateful to be joined by Simon Potter, who is, I would say, the ultimate central banking practitioner, formerly the head of the New York Fed's SOMA department and the head of markets there, and now the chair of FIC at Millennium. So thank you very much, everybody, for joining me. Why don't we just, I think, Perry, you're a great starting point because you are literally the man who says the lender of last resort function is transforming into a dealer of last resort. Why don't you frame the conversation in terms of that journey and how we got there, and where we are now and what is likely to come ahead?
Okay, sure. Can you hear me? Is that working?
We can hear you loud and clear.
Okay, fine. So you mentioned that New Lombard Street, which was published in 2011, which very much came out of also this my teaching in economics of money and banking, which became a MOOC. I wanted to just, because of some discussion yesterday, make clear those dates, because that's before 2015, that's before Basel III, before what Zoltan was saying sort of transformed all the world. So that book and the MOOC, which many people have seen, treats a world of scarce liquidity where the Fed funds market is actually a very important place for moving that around the banking system. It assumes that covered interest parity holds all the time. So there's a lot in that world that is not true anymore. Okay. However, I do think the main point of that book is still right. Okay, which is that we're moving from a bank lending system to a market-based system, shadow banking, so-called money market funding of capital market lending being my definition, and that means changes for central bank operation, for lender of last resort, shifting to dealer of last resort, which we saw the interventions that worked in 2008, 2009. And that were basically repeated in the COVID crisis much more quickly because of the learnings from those periods. So I think that has held up. What I would say since 2011, there has been this shift that was referred to in the panel yesterday in the organization of money markets, which continues. And I would also say there's, in my own thinking, the international aspect of the financial crisis, I underplayed in 2011. Okay, so international lender of last resort, I would like to put on the table here as well. And in particular, the key role of the liquidity swap lines for stabilizing FX swap prices, since that was mentioned yesterday too, as a key element. And maybe we can get into those things a little more clearly, but I do think both of those things, that the market-based credit and the international, shift us away from the classic Bagehot framework. We need to develop beyond the classic Bagehot framework to take into account these two key features of the modern world.
Thanks, Perry. And yes, sorry, I did mean me again misreading my notes. Knew by 2011, as in I guess it's the textbook. It's the go-to textbook, Perry.
I do have a new book, by the way. It's coming out soon. I just finished it. I just shipped it off. Okay, which is Money and Empire, Charlie Kindleberger and the Dollar System. So Cambridge Press, coming to a bookstore near you within the next 6 months, I suppose. Well, so I do have a new book. It just isn't published yet.
Excellent. Well, I'm glad we got that in there. So George, moving on to your perspective. So what are your thoughts on the back of what Perry's perspective on this is?
Well, first of all, I agree with everything that Perry said. When I think about, though, the big change in the Fed's role, I think less about it becoming more of a lender of first resort than about it becoming a borrower of first resort. To me, that's an incredible development, that you have the Fed becoming more or less the whole short-term money market, or a huge part of it. So I see this as a very important sea change, and with some implications that are very hard to trace. So I would just want to add the borrowing side to the equation, right? This idea that the Fed's role has changed a lot should include that aspect of the change. I think it's also important, and Perry gets this right, to distinguish between some of the more general changes in the Fed's last resort lending, and the kinds of changes we've seen recently with the COVID crisis that I think are to some extent sui generis, that we're not going to necessarily see them again. But we certainly see the Fed experimenting with kinds of last resort lending that it hasn't played around with for a long time. I think particularly the Main Street lending program was quite unorthodox since the 1930s, and I think also it is one that the performance of which raises a lot of questions about whether the Fed has stretched beyond its ordinary abilities and escapabilities. So I don't know if that's properly regarded as a trend, that sort of development. And it isn't just the Fed, of course, other central banks as well have done some extraordinary things that I think are not any reflection of, are not properly regarded as consequences in the general changes in operating systems and low natural rates of interest or other factors that can be driving secular or more lasting changes in the kinds of lending that central banks have to engage in. So I think we need to separate some types of advances or increases in central banks' undertakings that are not necessarily proof that the world has changed from ones that do trace, I think, to fundamental changes in the landscape of central banking. So that's what I would add.
Thank you, George. Simon, as the former head of SOMA, I mean, you were very much at the front line of this sort of transformation of the Fed into an increasingly dealer sort of based profile, both borrowing, lending, buying, selling. How have you know? Could you describe the evolution from your unique vantage point and how important it is in your perspective?
Sure. Thanks. Can everyone hear me?
We can. Yes.
All right. Well, thanks to the organizers for putting together a fantastic conference. We had two great papers this morning. So that first paper, I thought Hyun did a great job describing what the financial system looks like now. And there's a speech that Andrew Hauser, who's the head of markets, gave earlier this year, trying to describe three parts to what this new system looks like. First is what people call the non-banks. Remember, the definition of non-banks is they're not banks, but we don't really have a good way of describing what was called shadow banking. And how do we take some of the regulation and oversight into that area and get some of the prudential standards working there with a system overview? That was the point of Hyun's paper. I think you have to have a system overview. Then how do you make the CCPs, the financial market infrastructures, more robust? And finally, what's the role of the central bank? So the role of the central bank, I think if you'd spoken to central bankers 10 years ago and talked about market maker of last resort or dealer of last resort, they wouldn't really understand what you meant by that. Basel III, I think because of what it did to banks' balance sheets, and remember, banks are still very important in this mechanism, it made them much less elastic. So this notion of central banks' balance sheets being elastic in various ways, being the socially efficient structure for the system, is definitely more prominent now. And there's the number of issues that were discussed yesterday. I think George raised them of how do we really understand the system and how, you know, what are the trade-offs between some of the efficiencies we have with the central banks taking this role versus the incentives which we've changed in the private sector. And we don't have really good models or understanding of that yet, partly because, as I think Jim pointed out, we've got this very bank-focused approach rather than this system and how that system interacts in various ways.
So how do we see the system evolving in the next sort of year, especially with respect to the dollar question and the big question out there is really, are we going to more of a multipolar system? And if so, how does the Fed adjust in this new mode as a dealer of last resort? Who would like to take that question? Simon, go ahead.
So there's lots of discussions of a multipolar world, more reserve currencies out there on many metrics. And you saw this at Mark Carney at the last Jackson Hole they actually had in person, talked about, that's all true. There's something about the dollar or the US being less important, but the dollar as a currency, as a reserve currency, has become more important. So I don't think we're close to a multipolar world. The second largest economy in the world doesn't have open capital markets. Until you have open capital markets, it's very unlikely that that economic size and power will be reflected in having more than one reserve currency. The Fed, through the swap lines, which were turned for the major central banks into standing swap lines in 2013. So that means people don't realize this. There were auctions every week from 2013 onwards. They weren't suddenly turned on in March 2020. They were just increased in the frequency. then the swap lines were extended again to a wider set of central banks. Perhaps more importantly, and this goes to your dealer of last resort or dealer of first resort, the Fed agreed to run a repo facility with foreign central banks. A lot of treasuries are held by foreign central banks. That's now been made permanent. And in that one, a central bank can convert up to 60 billion of US treasuries into cash overnight, which I think stabilizes the dollar-based system, not because it will be used that much, but because if you're planning, you don't need to make precautionary sales. As you might have done in March 2020, you know you have this good source of liquidity as a backstop.
Perry.
Maybe I'll chime in. So yes, I agree with all of that. Yes, that we are not moving toward a multipolar world. And the crisis very much confirmed the centrality of the dollar, if anything. And the fact that the Fed acted as it did means that de facto, the Fed is acting as central banker for the world, okay, which it was very, very loath to do in 2008. So this is a big sort of change that we've sort of accepted. You know, it's a dollar system. That means the Fed is the global central banker indirectly, you know, through this system of swap lines, dealing with other central bankers. So maybe you could say more correctly that it's a committee of central bankers that this swap line committee, okay, is the global central bank. But Izabella, your question was also about sort of what is the future. I think it's important to appreciate that this pandemic is an odd time. Okay, this is like a war finance time, okay, where interest rates are zero, where the central bank is in fact taking over the money market, just as we would do in wartime, okay? So I think the question of the future is about how do we transition from war finance to peace finance, okay? This is like, you know, the end of World War II, you know, how do we put this system back together again? Now, it hasn't all gone to autarky like the way it did in World War II. So I think it will be easier, okay? But I think that imagining that this is just about sort of tweaking is underestimating the challenge that we're facing. The reason, as well as George was saying, the reason the Fed is all involved in that is because of this war finance aspect, and the green aspect is sort of development finance. You know, that again, it may be that the central banks will be called upon, and not just the Fed but others, for this great energy transition that we're making. So I think those are the real economy backstop of what you're seeing in this extraordinary growth of central bank balance sheets. And maybe the last thing I would say, if the central bank, for whatever reason, thinks that it needs to keep interest rates really, really low, that makes it the lender of last resort. No one else is willing to lend at that rate. So you're not backstopping the market, you are the market, okay? Shifting from being the market to backstopping the market is the challenge ahead of us.
In a world where all these central banks effectively are the market, though, what is the risk associated with that? George, perhaps you might be able to share some thoughts.
Well, first of all, I want to say that for our panel, at least, it's unanimous that we're not moving towards a multipolar world. And to answer your question, I think one way to think about what has happened as a result of the last two crises is that the dollar's role has been enhanced in a manner that involves a certain a kind of moral hazard, right? The Federal Reserve, as it were, has extended the safety net more broadly to include other central banks and the dollar generally as a worldwide currency. And as a result, one would predict that people would risk using the dollar more than before in those international transactions where they might choose to use something else. So the risk is precisely that the Fed has more work cut out for it, both in its own decision-making, but also with respect to its relationships with other central banks. It's got to be ready to help them out to the extent that their nations are involved in any dollar crisis or excess dollar demand that is likely to occur with the next crisis. I'm not sure this is the worst possible state of the world. There's a sense in which a multipolar world would be one with more diversity, where we don't have all our eggs in one currency basket. So if we do have a crisis, it isn't all up to the Fed, for example, to be making the market. But on the other hand, there's much to be said for a system where the coordination is a problem of dealing with crises that are inevitably going to be international is made simpler by having a single currency and only having to have arrangements whereby the ultimate provider of that currency can arrange to be a source of liquidity worldwide. So anyway, I think the risk is precisely that we are dependent more and more, the world is dependent more and more on a Federal Reserve that can accommodate dollar demand worldwide when there are crises, and the natural tendency is for the dollar to become more coveted than ever.
So as a journalist, I'm really interested to know how, like, from a practitioner's point of view, Simon, when the Fed was rolling out all these new facilities, we really struggled to keep up with them. If you're there on the ground, what does it look like? What does it look like? How has it evolved dealing with the market directly? I mean, could you give us any insight into, just structurally how that operates at the New York Fed? How, are you all, is it the buzz of a sort of bank dealing room nowadays? What does it look like? Or is that too secret?
So let's step back. There's a discount window that was used quite a lot in March 2020. And every depository institution has a right to sign up to that. That's distributed across the 12 reserve banks, because of the large banks in the New York area, that's often a focus there. Then there are the primary dealers of the New York Fed. There are 24 of them. They represent a lot of the private flows. And I think some of the commentary we've just had makes it look like the footprint of the Fed is actually quite a bit bigger than it really is. It's still, most of the flows are going through the big dealers in the US. Many of the operations that can be put in place quickly by the New York Fed will go through the primary dealers. So the primary dealer credit facility was one of those. That's because it uses the tri-party platform, and you can take some of the private valuation services, the margining that comes from the discount window, and operate that very quickly. Other things take longer to do. The commercial paper funding facility takes time to set up because you need to have some agents to run that for you. I don't think it's sensible for the central bank to have built up, large structures for the part which is the emergency. So you could practice that so you can set it up a little bit quicker, but in general, you'd want to use the private sector to do that. The corporate credit facilities took a while to build up, and what you saw at first was using the most professional expertise, which was from BlackRock, and then extending that. If you go look at the list of counterparties now that the Fed has now they're actually selling some of those corporates. That's quite wide. And I think that's somewhere the central banks will go over time. There is a difference between operations where you're buying and selling and operations whether you're lending, which I think have the highest issue of how you look at your counterparties versus the operations that you borrow at. The Fed obviously now has almost 100 money funds that it borrows from overnight. In terms of lending, we have the discount window and the primary dealers. The decision in the new standing repo facility was to look at first expanding that to banks of a certain size. Remember, banks still have the discount window. Maybe the goal there is to take away some of the stigma from the discount window.
I mean, I find that all really fascinating. I'm interested to know, though, as the sort of, if we move increasingly into CBDC world and the list of counterparties grows ever more and even starts to include sort of everyday commercial accounts of retail accounts, right? How is that structure going to evolve further? Are we going to outsource a bunch of that activity to the banks? How do you anticipate that sort of expansion of the balance sheet evolving?
So as you probably know, central bankers in general quite like the two-tier system. And the two-tier system is banks bank with the central bank and people and corporates bank with those private banks. I don't see CBDC necessarily changing that. Many of the proposals you've seen, the ECB, the Bank of England, I have a proposal for the Fed, they're all two-tier systems. There's a much bigger issue about the non-bank financial counterparties. And what is the structure there? And that depends a lot on the financial system. In Europe, it's more bank driven. And there's, I'd say, a good set of standards there. They have basically equal access. In the US, given how heterogeneous the non-bank sector is, given some of the legal restrictions some of these firms have, it's not clear how to set up a good counterparty structure there. Over the next 10 to 15 years, I'd expect there to be more work on what is the appropriate counterparty structure. Right now, it's sort of operation by operation, as I indicated. So the money funds have access to the overnight RRP. That's really all they could do with you because they can't borrow that much. It's not in their investment guidelines or how they're set up.
Perry, I was just wondering what your current views are on this evolution and move potentially into a CBDC world, and whether borrower of last resort is effectively going to change your money hierarchy in any way.
Well, I don't really see CBDC changing anything fundamental. There will be details, and the system does keep evolving. I would maybe underline what Simon was saying about he called it a two-tier. The hierarchy of money there is what when I teach it, I call that hierarchical system. And of course, there's really more than two tiers when you really look into the details. And I think there's good reason to like that, by the way. Okay, and it's important. And it's difficult for well-trained economists to appreciate that because we tend to see a flat world, a world where there's end markets or something, and anything that is hierarchical smacks of non-competitive or something. But I think monetary systems are inherently hierarchical, and we were just talking before about why is the dollar is this big thing and we don't have 150 currencies. Well, it's the same within the dollar system, that there are advantages to efficiencies to this system. I like to pick up on this idea of these standing repo facilities that have just been started, the FEMA repo facility, the FX swap facilities, all of these. It's important to appreciate that these connect with this dealer of last resort idea, because if you have a two-sided, that markets can make mistakes in both directions, right? They can make liquidity too cheap or they can make it too expensive. When we talk about lender of last resort, we're really thinking about the market making it too expensive, and so the central bank steps in and creates a bound on that. That's that it's willing to lend freely at a high rate, the Badget world. But it's also the other way around. That once we have private liquidity providers, they can make it too cheap, and so the ability of the central bank to intervene to put bounds on the system on both sides, okay, is going to be key, I think, for regulation going forward, given the dominance of the market-based credit system. And that's sort of the outside spread, we call that, okay, in the dealer model, where you're not necessarily doing much trading, but the fact that you are offering trading options away from the market creates a little corridor within which the market can do its own thing. That's me thinking, watching institutional evolution, thinking what is the logic of this evolution, and connecting it up to this centrality of the dealer function sort of view, which I came to, 10 years ago when it was unpopular. Okay, and now it's getting into the water, and we're starting to build out actual institutions. It's quite a wonderful thing to be watching, I must say.
George, perhaps you have some thoughts as well.
Yes, I do. I think it's important to think about to distinguish between the implications of granting broader or non-bank access to the Fed's balance sheet through accounts and granting broader access to its lender of last resort facilities. I'm sure Simon is quite right that central bankers would rather maintain a two-tiered system, and I would assume that even those who might favor allowing ordinary customers to have Fed accounts, ordinary people, as one way of implementing central bank digital currencies, would still be very hesitant to grant overdraft facilities or last resort lending facilities to these individual account holders. That would be quite something if the Fed were to take that step. And likewise, there's a movement which I favor to allow, you can call them non-banks or you can call them specialty banks if they have that sort of charter, but fintechs to have Fed accounts. And in that case, I think the English model, the British model, where these are narrow, these resemble narrow banks and holding only very safe assets, either 100% reserves or reserves and some treasury securities. There is presumably not much need for those account holders to have access to the discount window because they're not engaging in the kind of maturity transformation that banks engage in, that exposes them to losses and often makes it necessary for them to resort, or sometimes makes it necessary for them to resort to the discount window, for example. So my own view is I'd like to see a world where we have a second tier arrangement of some kind, where ordinary people have access, may have special ability to access the financial system without dealing with banks, though I think fintechs could deliver that as well as banks in cooperation with the Fed, but where the Fed's last resort lending facilities are made available only to banks and not to depositors or holders of CBDC balances, or to fintech firms. At least I wouldn't think that would be a desirable step. I will add one more point here that relates to the whole question of last resort lending and central bank digital currencies. I am one of those who's a little bit concerned about the disintermediation risk that these arrangements could pose, that central bank digital currency could pose, particularly if it's implemented the way some of its advocates would implement it, where the central bank balances held by ordinary folk would yield interest at the same interest rate paid on bank reserves. At certain times especially, that could make those deposits quite attractive. And if the interest rate is indeed written in stone as a function of the legislation behind it, then there is some danger. We saw in the 1930s how the postal savings system became very attractive relative to ordinary bank accounts, and its interest rate was higher than those accounts and was set so by legislation that couldn't easily be changed. Fortunately, those account balances were capped off at a fairly modest level. So what I would hate to see is central bank digital currency becoming a source of bank disintermediation that makes it necessary not for the central bank or for the Fed to lend to or people who have balances with it directly under this program, but forces the Fed to do a lot more emergency lending to banks at certain times. That would be unfortunate.
I mean, we've touched upon the sort of evolution. Oh, sorry, you were going to say something?
I'm all finished.
Okay. We've touched upon sort of the other sort of evolving trends, including, you know, whether independence is at risk and these other factors. I was just wondering, in a world where, okay, we move towards a more narrow banking sphere for some of these entities, what's in it for them, number one? Because when we look at China and we look at what has happened with WeChat and Alipay, as they've moved into this narrow banking model, that seems to have been a point of friction, and certainly has dispossessed them for a lot of the kind of profit potential that they might have had previously, and there seems to be some potential bad blood going on there. So what's in it for them? And secondly, if in this world of you know, where the CBDC can sort of be politicized and be used to potentially, you know, for programs such as furlough or other sort of monetization, you know, helicopter drops and all that sort of stuff. You say it's not a lender of last resort, but does it qualify as a lender of last resort if it's an implementation tool for broad social policies like that?
Well, I haven't got an answer for that one. I'll defer and see what the others have to say. Of course, all kinds of things are possible. But it's not a scenario I've thought about.
Anyone else maybe have any thoughts on that?
So I think maybe we shouldn't be putting central banks right in the middle of this. There's a bunch of issues about who owns the data that we produce. And that happens in payments quite a lot. So part of the discussion, I think, in China is it okay for the private sector to control that data that much? I once visited a WeBank, which uses some of that data, and they can lend in a very efficient way because of all the data they've collected on individuals. They use AI and other things to decide how to give out credit. Now, as an individual, I don't really control that. It would be good if we had a better way of deciding whose property this information is. And most likely consumers are not getting their full surplus from that information. I view that as a problem for the private sector. Any kind of central bank digital currency is going to have to decide that. You can call it the privacy issue. Another set of issues, which if you look at Sweden and other ones, is how do you make the payment system robust? So there's cyber threats, and clearly the more electronic payments become, you have a risk related to those. How do we make sure that we have good backups? The best backup in the world for transactions is still paper currency. So if you look at Sweden, there's a reduction in paper currency, but they're still going to have stores of that. So I view it more as how do we make the payment system work in a way that shares out this benefit of all the information, and how do we ensure that it's robust over time to cyber and other kinds of threats?
Perry, any thoughts? If not, don't worry.
No, as I said, I do, I guess, agree with Simon that I imagine that CBDC is going to be like bank reserves, okay? But if you move in this other direction, I think that I'm very welcome this idea that we need to be thinking as a policy matter about who owns the data that we produce. But we've wandered a little far from this lender of last resort topic, I think, in this conversation.
But have we, Perry? But because for me, like a lender of last resort function is about stabilizing, you know, a crisis, right? And in the event of the pandemic, certainly furlough played a massive stabilization role. And yes, that was a treasury based you know, tool. But if we have this sort of blurring of independent central bank, you know, with government policy increasingly, might the central bank become an arm for that sort of policy? And in that case, that is I would say that's a lender of last resort function, but on a more direct economic basis.
Well, so the blurring of the fiscal and the so when you talk about central bank independence, you're talking about independence of the treasury, yeah. I suppose. And in a time of war, you do not have that independence. You know, that the job of the central bank is to fund the government until we win the war. okay? And we still haven't won this war. So I don't think that we're going to see independence until we win this war. And apparently we're still fighting it.
So in that sense,
and then I think we will. And then I think we will make this transition to peace finance. So that when I thought about war finance and peace finance, that is my framing of this question of fiscal dominance versus monetary independence.
I see. So I would like to invite questions from anyone who is watching. We have one from Bill Nelson. It's not directed to anyone specific. What do you suppose the Fed has designed? Why do you suppose the Fed has designed its standing repo facility as an auction facility rather than a standing facility? It looks more like the latter term, auction facility, auctioning larger quantities than will be demanded, which was called the term auction facility because it wasn't a standing facility. That's a bit, I guess, to unpack that. Perhaps Simon, are you on top of that?
So, yeah, I think I know where Bill's coming from. So there's a $500 billion limit to the standing repo facility. There's some discussion you'll see in the minutes about whether you needed that limit. Total repo outstanding in the COVID crisis was 495 to the primary dealers. So it seems to be sized in that way. There's some collateral differences that are in there. So that's another reason, because it takes more than treasuries to allow for bidding at this. And I view the bidding as a way of trying to deal with some of the stigma issues that might come up, and that is to be determined. So it's probably the case that borrowing against such high quality collateral does not have the same stigma as a bank that goes to the discount window. We'll have to see whether that's the case. We won't see the standing repo probably used for quite some time. Because there's some issues around the debt limit where you could see it being used in a strange way, but because there's so many reserves in the system. What the Fed has done is every day, for sure, this auction will be taking place. So that's just like the FEMA repo is already there. If you've arranged with the New York Fed, you've got the right to use it. It's there. That stabilizes markets just as its active use would. And that should lower the frequency of events where you need to actually use the central bank liquidity.
And there's a follow-up question about whether, if assuming the haircuts on the facility are large enough to make the loans essentially riskless, would that induce a moral hazard? So actually, there was something I wanted to mention, that the ECB did do an innovation in the crisis. It's an idea that Ulrich Binzel had, where actually what happens is you have haircuts. So if I bring a long-term treasury to the Fed, I get 97 cents on the dollar. What the ECB did, and which was quite clever, is it reduced its haircuts. And in other words, it lowered it allowed you to borrow more for the same collateral. The argument there is pretty similar to Hyun's one, that there's an externality out there. The central bank should look at the system as a whole. The system as a whole requires the central bank to take risk on its balance sheet. And the central bank can do it because it's part of the government, and your lender of last resort is its future generations through their taxes will make up for, if there are losses on that. So I don't think we should worry about the haircuts on US treasuries. And I don't think there's a way, given what Hyun showed us, of dynamically margining so you get just the right incentives. What you do is you look at how volatile, say, a 30-year treasury is, and you decide how long the central bank wants to hold it. You use value at risk, and that creates your margin, which are published for the discount window and the methodology behind it. And Simon, whilst we have you on this topic, given the previous presentation was about green bonds and the central bank's sort of involvement in purchasing that sort of asset, And since 2020, obviously, we have seen the Fed venture increasingly into the sort of asset dealing world and into ETFs and a broad spectrum of securities. What's your view on sort of where the buck should stop in terms of, the subjectivity of these asset purchases and securities?
Well, just say that Monika Martin's paper, I can't remember who the other co-author was really excellent. That's why you want really smart people working on this. It shows you just throwing around market neutral is a very complicated term. For the Fed, the amount of corporates they bought was quite small. These corporates are being sold. I don't view that as a really big issue for the Fed. There was a decision to buy ETFs. That was a very brave decision by the Fed. Operationally, it was a little bit easier to buy ETFs. It also resolved some of the issues about picking winners and losers. You still have the problem, who is the sponsor of that ETF? And I don't have a good answer when you're in the war situation the Fed was about, what the right answer is for that. And I don't think it's particularly helpful for the Fed to plan out a whole way. This is how we'll buy ETFs in the future. Some ambiguity around that will probably be helpful.
Right. I mean, obviously, there are other central banks that have for a long time been, operational in the equity markets and being quite, subjective about it, from the BOJ to the Swiss. So do you think that is, in terms of like the paradigm we're moving into, do you think inevitably the Fed will have to come face to face with more market focused sort of operations in that sense, or not?
Probably not. Roger Farmer, as most people know, is a big advocate for central banks stabilizing through buying equity markets. I don't think that's necessary for central banks to do. There are very specific reasons for central banks to intervene in equity markets. Hong Kong is the example that people use. Definitely exchange-traded funds have made it more operationally feasible and less risky in terms of choosing winners and losers. There's a separate set of issues if you've got large official reserves, which the Swiss have or some other countries do. You want to diversify that across asset classes. And that's going to involve you in equities. I view that more as a sovereign wealth issue than a central bank issue.
Right. Perry, go on.
So a more general comment. I mean, this role that the Fed played bravely in ETFs in March 2020. What I just want to have everyone be aware of is that there's an institutional evolution that's going on here, that ETFs are a new thing. Okay, there were no ETFs during the last financial crisis. Okay, so we didn't have any plan on how to deal with the ETFs because it wasn't even on our radar screen. Okay, and even coming into it, exactly how these systems, how these new institutions would behave under stress. Okay, what you could sort of guess, but we found out. Okay, and so this is the process we're in. That when there's stress, you find out where the system breaks. Okay, and then you learn something. Okay, and it won't break in the same place next time. It'll break somewhere else. Okay, and it's a constant evolution. That's happening. I would give the same answer to Bill Nelson's questions also about auction. Like from a certain logic of market-based finance, you would imagine we are moving toward a standing repo facility, okay, as an outside spread where you are paying deposits at less than the money market rate, and you're willing to lend at more than the money market rate, so that you're out of the market on both sides, and you can see the role for a central bank as creating that outside spread as a stabilizing function. But we're not there yet, and we may never get quite exactly there because there's lots of other things that are pushing. So that it's the institutional evolution that you're observing, and where we are now is not where we're going to be 10 years from now, or even 1 year from now. But I think that seeing the direction in which we're going helps us to understand that this isn't just random. You know, that there's there's an evolution that is happening here, and it has a direction. It has a direction to it, and it's not just political decisions here or there, or that the central bank is bought and paid for by the banking industry. I don't think that's true. You know, the politics of this are very important. You know, the way it looks to the world are very important. You need to be able to explain what you're doing and why you're doing it, so that it seems that it's in the public interest. That's very important. And so a lot of this moving slowly is about that too. Is getting buy-in to these new institutional structures.
I mean, you make a really good point about the central banks having to be continuously sort of adapting to the new sort of entities that are out there, ETFs being one of them. I think, you know, before in 2008, certainly it was breaking a buck. That was the stigma that would have spooked all the markets. But then we found out in 2020 that it was the NAV price sort of deviation that people were watching furiously, the market was watching furiously, and that was now the new thing that the Fed had to influence. In this new, I mean, to finish off, I know it's a lender block. Sorry,
can I just say one thing?
Yeah.
I don't think ETFs were the center of anything that happened in March 2020. They worked as they were supposed to work. It was just convenient to buy ETFs.
All right, so there was no concern about the fact that there were ETFs with, you know, potentially illiquid assets within them, and the sort of market.
There was a price discount. Effectively, they implement the swing pricing in a way that open-ended mutual funds don't. So there are issues. There's always the issue when prices go down. That's bad when you're holding assets, and that can cause panics. That's the Kindleberger type thing. That's usually one of the biggest forces in any kind of financial crisis.
For sure, yeah. It just seemed to me at the time like the market seemed to be really furiously watching those deviations and looking for some harmony in them. But it's interesting from your perspective.
Let me speak to that. I mean, one more kind of big picture way of thinking about this is that what this financial innovation often is about private entities, financial entities, selling liquidity services of some kind or other, and making a profit on it until it comes time to actually deliver. Okay, and then they find out that, then the world finds out that, well, you can't necessarily, the only person who can always fulfill their promise to deliver liquidity is in fact the central bank. And so because they can expand their balance sheet on both sides, they can create the means of payment. And that is not true of an ETF. They say it's our intention, you know, to allow minute by minute liquidity in this fund at the NAV, you know, but how exactly are we planning to do that? You know, that's not, that intention is not a legal contract. And the question is, do you have the mechanism to actually deliver on that thing that your customers are encouraged to believe that you can? Just like breaking the buck, as you said, you know, that you're encouraged to believe that that's true, but it can only be true if you have a mechanism in place for fulfilling that. And those things get tested in a crisis. You might believe you have that mechanism and then discover that you don't actually. So I'm not saying anyone's necessarily committing fraud here, but we're learning. We're learning as we're going, because this is also a general equilibrium problem, not institution by institution, and it's dynamic, you know.
Absolutely, George.
Yeah, I think that we are learning, and I think swing pricing and other mechanisms like it can go a long way. When you're talking about equities, there's certainly, on paper at least, a lot of ways to make them relatively safe from the kinds of panics that we've seen. That's just that we haven't worked out all the bugs required to get that right. I wanted to add something on Bill Nelson's question. It seems to me that there's a lot to be said, of course, for a full allotment standing repo facility that's simple, and you peg your interest rate just where you want it, or at least put a ceiling on it just where you want it, and that's that. You provide all the liquidity that people want. At the same time, though, once you start talking about having different counterparties and different kinds of collateral, when you throw those things into the mix, then it's not so clear that you don't want a more sophisticated pricing system setup. I think about the Bank of England's indexed long-term repo facility, which of course is another auction setup, and they have these clever product mix auctions. I've always been very fond of that arrangement because basically different counterparties are able to express, as it were, just how much they're willing to pay using different kinds of collateral. So I don't know if the Federal Reserve is thinking in those terms, as well as thinking about how to best avoid stigma. But I can understand why they might be considering these other arrangements. Personally, I'd like to see a facility like what the Fed is putting in place or has put in place become a real substitute for the discount window, if only because the number of different facilities out there seems to create an overly complicated system where, in principle, at least, if we had one standing facility to set the upper limit on short-term interest rates that could deal with different counterparties, including banks, and also different kinds of collateral all at once, that would be nice, and at least an ideal to think about.
So I'm afraid we are out of time, but just as we close up, George, I just want, in terms of the lender of last resort function, in the world of multiple private currencies that are emerging out there, what do you see the role of the central bank in the event of, say, one of these private stable coins, going bust? Do you think it will be self-stabilizing? What do you think the consequences might be?
Well, I hope that as long as the stable coins aren't already huge, that central banks will resist any temptation to help them, because that for it to intervene, I think would create a very serious moral hazard. But I personally think that the risks of a crisis coming from stable coins is much exaggerated. I take the case of Tether as an example. It, of course, is the biggest so far. It might not be bigger than Diem when that comes online, but it is by far the biggest. And yet the demand for Tether is exceedingly robust, amazingly robust. I put it on Twitter that if you tried to set up an experiment where you created a stable coin designed to cause a crisis and then exposed it to the biggest risks you could come up with, you'd run what we've seen as the Tether experiment, and yet the darn thing is still there. And one of the reasons why it's still there is that it has a lot of backup, for one thing, and it also the demand for these things is peculiar. There aren't close substitutes for them. The people want anonymity and so on, and they're very hard to redeem. To be honest, there are all kinds of gates in place and restrictions. So I think we should just let them fend for themselves, and that it would be a big mistake for central banks to move too quickly to concern themselves with having the ability to bail out stable coins. I think it would be a better idea at this point, while it's not too late, for them to send the opposite signal that these stable coins can go on fending for themselves. We do see failures, but they're mostly of algorithmic stable coins, and those are another very, very different sort of beast, and the spillover effects are not what you would have if you had a big sell-off of commercial paper or other underlying assets, as you could in principle with Tether.
Perry, Simon, unless you're burning to have a last word on that topic, wave if you do. If not, I will close the panel there, but do wave if you want to say anything else. I see no waving. Okay, so thank you very much. That was really fascinating. Yeah.
Thank you, Izabella.
Take care.
Thank you, Izabella. Thank you all.
Thank you, Izabella. Thank you, George. Thank you, Perry, and thank you, Simon. Also, I want to mention that actually what got me started is actually Perry's MOOC. So I'm happy that it comes to that. I think now we deserve a 5-minute break. So let's do that, and then we reconvene and we start with the academic session. All right, so welcome back. So it's 5:40, so we are going to start with the academic session. And the first paper is by Kyungmin Kim from the Federal Reserve Board. And Kyungmin, the floor is yours.
Hi, thank you for inviting me. So in my presentation, I'll talk about monetary policy implementation with an ample supply of reserves. Of course, the views presented here are mine and those of my co-authors, and they do not represent in any way the views of the Federal Reserve System or any Federal Reserve policymakers. The starting point of this paper is that in 2019, the Federal Reserve announced that it would implement monetary policy with an ample supply of reserves. In this paper, we consider whether this is a good idea, and we ask a close related question of what the optimal level of reserve supply is. Looking back at the reserve supply over the last 15 years, here we are showing the time series of reserve supply between 2007 and 2019 before the outbreak of COVID. As you can see, before the quantitative easing following the 2008 financial crisis, the supply of reserves were very close to zero, as you can see on the left end of the panel. You can almost not see the line because it's just so close to zero. However, following quantitative easing, a lot of reserves were injected into the banking system. And after the financial crisis has passed, between 2017 and 2019, the Federal Reserve was reduced the amount of reserves by a very large amount, by more than $1 trillion. Looking back at pre-2008 world, the Federal Reserve was implementing monetary policy with what's called a scarce reserve system. And in the system, the Federal Reserve used to make daily forecasts of factors moving reserve demand and supply, and would conduct open market operations to counter these movements. And it is easy to visualize using a simple reserve supply and demand framework. Here, blue line represents a downward sloping reserve demand curve, while vertical lines represents reserve supply that's largely determined by the Federal Reserve. On each day, shocks to reserve supply and demand would move these curves horizontally. And what the Fed did was to move reserve supply through open market operations to a place where the resulting equilibrium interest rate would be very close to the target rate. Following QE, large amount of reserves were injected into the banking system, which moved the reserve supply curve very far to the right. And around the level of abundant reserve supply, banks didn't have any need to hold additional reserves, so they valued reserves just for the interest in reserves that they could earn from the Federal Reserve based on their holdings of reserves. And that meant that reserve demand was basically flat. And in this world, moderate shocks to reserve supply and demand wouldn't change the interest rate, the equilibrium interest rate at all. And that basically eliminated the need for any frequent open market operations by the Federal Reserve. Between 2017 and 2019, as I said earlier, the Federal Reserve drained more than $1 trillion of reserves. And we can think of that as the Federal Reserve basically moving reserve supply much to the left, closer to the kind of steep portion of reserve demand curve. But still, in the end, we could only see occasional and minimal movements in the Fed funds rate. So the Federal Reserve was still operating with around a relatively flat section of the demand curve. Now, there were unexpected repo market dislocations in late 2019, which kind of prompted the Federal Reserve to stop draining reserves. But even before that, the Federal Reserve did not plan to return to a scarce reserve supply. So what has changed from the pre-2008 world that made Federal Reserve make the decision? One important factor was that the characteristics of reserve supply and demand have changed since the financial crisis. They have in particular become more volatile and harder for the central bank to forecast precisely. Looking at reserve supply, it is useful to note that in the absence of any central bank action, the change in the reserve supply to banks is the same as minus the change in reserve balances held by non-bank entities. This is just an accounting identity. And what we see is that the right-hand side has become much more volatile since the financial crisis. So here in the bottom panels, we show the time series of volatility in selected non-bank entity accounts at the Federal Reserve. On the left, we see that the volatility in the balances held by the US Treasury has increased substantially over time, with the vertical line marking the beginning of 2009. In the middle, we see the same for the balances held by foreign official and international organizations. And on the right, we see the same for the balances held by certain GSAs and financial market utilities. Now, these increases in volatilities are to some degree endogenous because the Federal Reserve didn't have to worry about moderating these volatilities given an abundant supply of reserves. However, these are not just endogenous in the sense that Federal Reserve will find it very difficult to reduce all these volatilities to a pre-2008 level. There were changes in banking regulations and institutional arrangements that kind of has made it difficult. For example, with stricter balance sheet regulations, banks are now much less willing to let institutions hold these large and volatile deposits on their books. And stricter banking regulations also meant that the nature of reserve demand has changed. Now banks are willing to hold a large amount of reserves unrelated to reserve requirements, which by the way was recently kind of removed. And they are willing to pay substantially more than IOR to maintain some level of reserves. And we can see that from various surveys, including the Senior Financial Officer survey conducted by the Federal Reserve. And these regulations are not so simple, and that makes it difficult for the central bank to exactly forecast reserve demand. For example, if we think about liquidity coverage ratio, banks need to hold enough high-quality liquid assets based on as a function of their kind of liability structure. However, in meeting the requirements for HQLA, banks can choose by discretion between reserves, government securities, and other lower quality assets. Now, in the kind of next part of the paper, taking these observations into account, we propose a stylized model of monetary policy implementation where the central bank chooses the optimal level of reserve supply. And depending on model parameters, either scarce or ample supply will turn out to be optimal. And the model basically illustrates in a kind of stylized way how efficiency of implementation or concerns about implementation cost affects the optimal choice. The model is static, has 6 periods, and we can think of that as describing events happening over the course of the day. In period 1, the central bank chooses the baseline supply of reserves, which we call R. And next, reserve supply shock S is revealed. In period 3, the central bank, after seeing what S is, adds or range reserves by the amount X. Next, in period 4, a demand shock is revealed, which is an aggregate of demand factors affecting individual banks. Now, for convenience and for easiness of interpretation, we call these shocks SMD, supply and demand shock. But the real material difference between them is that S is forecastable and D is unforecastable, in the sense that when in period 3, the central bank determines its operational position, it knows S, but doesn't know what D is. It only knows the distribution of D. After this, in period 5, the federal funds market clears in a competitive way, and the Fed funds rate is determined. And finally, after market closes, each bank receives a further shock to reserves. Solving the model, starting from the back, at the end, after all shocks have been realized, a bank's marginal value for reserves is just step function, which is the kind of like simplest form for us. So the bank values reserve holdings at a higher value to a certain level, which we call lowest comfortable level. And this level moves horizontally with the reserve demand factor that has been realized in period 4. And beyond that, banks have no need for reserves, so they just value reserves, their reserve holdings at the interest in reserves. In period 5, in the Fed funds market, a bank determines their holdings of reserves using their marginal value curve. Now, since there's a shock that will be realized in day 6, the banks look at their expected marginal value curve, which is the smooth version of the step function marginal value curve we just saw on the previous slide. And this marginal value curve will have a steep portion for relatively small holdings of reserves and a flat portion for relatively large holdings of reserves. And this whole curve will shift by the demand factor that was realized in period 4. From the central bank's perspective, in period 3, what it cares about is the aggregate demand curve, which is a horizontal sum of individual banks' demand curves. And this aggregate demand curve shifts by the aggregate demand factor, which is sum of individual demand factors, and it is a random variable, which means that even after the central bank has determined its operational position in period 3 as the sum of initial reserve supply, the supply shock in period 2, and its operational position X, there will the equilibrium interest rate is still a random variable because of the stochasticity in the aggregate demand curve. Now, looking at central bank actions, we can, loosely speaking, we can think of the central bank as basically choosing X to offset S plus D, and knowing that D is still a random variable. And what the choice of initial reserve supply R does is that it determines how large X will be and to what degree X will offset S plus D. To formalize, the central bank wants to minimize the following 3 kind of operational cost objectives. It wants to minimize interest rate uncertainty. It wants to minimize the size of operations, and it wants to minimize the level of reserve supply, which we interpret as a political cost. Now, we don't really kind of, I guess there can be questions to ask about what the nature of this political cost really is. We don't offer a good answer to that in our paper, but I want to note that this was definitely a practically relevant concern. There were some speakers yesterday talked about this as well in the conference, and there were various policy communications by Federal Reserve policymakers about not holding any more reserves than necessary, as long as it is consistent with their operational objectives or criteria. So the objective function is simply a weighted average of these with exogenous weights given on each of these 3 factors. And note that in period 1, the size of operations and the equilibrium interest rate are still random variables. And finally, we put a restriction that the central bank, there's a kind of lower exogenous limit on the choice of R, which we interpret as the central bank wanting to supply at least some level of reserves for market functioning. Now, the first result is that there are 2 local optima in the choice of R, which we interpret as scarce and ample reserve supply. And it is easy to see how why ample reserve becomes a local optimum. So imagine the central bank supplying a huge amount of reserves, then it'll be operating basically the only relevant sections of demand curve will be totally flat. That means that the central bank will not have to worry about interest rate uncertainty or conducting operations at all. So the central bank will optimally decide to reduce reserve supply from that kind of configuration because it can just save on the cost associated with the size of its balance sheet, and after or the supply of reserves. Now, and it will keep doing that until it'll be somewhat the reserve supply is somewhat close to the steep portion of the demand curve, because only then it'll have to start worrying about conducting operations or the residual interest rate uncertainty. And if the basically if the weight that is given to the marginal cost, political cost is small enough, then there will be a local optimum near the place where the the slope of the reserve demand curve transitions from flat to steep. The idea behind and the local optimum at the scarce reserve supply is similar, since if the lower bound is in some sense deep in the steep portion of the demand curve, then increasing the reserve supply a little bit from there doesn't do anything other than increasing the political cost, so it'll just stay there. So the problem can now be narrowed down as the choice between scarce and ample reserve system, and the choice really depends on the distribution of S and D. So we take a useful simplification. S and D are basically independent, and we parameterize these shocks as having a jointly normal distribution with two parameters. First, sigma characterizing the total magnitude of shocks, and rho characterizing the relative size of demand shocks. And the next result, which we state in a technical fashion in the paper, but here we can loosely say that ample reserves are relatively preferred for larger shocks. Why? Because with ample reserves, the Federal Reserve is operating at a relatively flat portion of the demand curve. So increasing sigma increases potential interest rate movement only moderately, and it also increases the cost associated with offsetting those interest rate movements, basically the cost of operations only moderately. While with a scarce reserve supply, the reserve demand curve is relatively steep, which means that an increase in sigma will have a much bigger impact on the residual interest rate uncertainty or the size of operations. So in this particular example shown, what we show is that we show the central bank's cost as the choice of baseline reserve supply, and with relatively small sigma, the scarce reserve supply is preferred as the optimum. But once you increase sigma while keeping all the other parameters fixed, the increase in cost is much greater for the scarce reserve supply system, which makes ample reserves optimal. Now, to think about the effect of increasing rho, we can use a simple example even a simpler example to illustrate that. So here, imagine that S and D can be either +1 or -1 with equal probability. And what the central bank does is that it wants to offset S plus D. And if S is -1, then S plus D will be either -2 or 0. And if the central bank chooses a small positive X, it'll help in the state where S plus D is -2, but it's going to hurt the central bank in the state where S plus D is 0. So it'll ultimately choose not to conduct any operation. And basically that idea extends into the paper. So when rho is larger, that means that there's a large kind of residual uncertainty even after the central bank has chosen its operational stance. And that means that kind of in expectation, open market operations are less effective in reducing interest rate movements. So scarce reserve supply will be kind of less preferred for larger rho, because with scarce reserve supply, the central bank has to depend a lot on conducting large operations, while with ample reserve supply, it doesn't depend as much on conducting market operations as well. So market operations becoming less effective is less of a problem with an ample reserve supply. So to summarize, in this stylized model, a larger sigma makes the central bank just wants to avoid costs associated with reserve supply and demand shocks by just supplying ample reserves, and so that it can be at a place where it doesn't have to worry about these shocks to begin with. And this is kind of our interpretation of the post-financial crisis increases in the volatility of reserve supply and the uncertainty in predicting reserves demand. The idea behind a larger role making ample reserves more preferable is similar. Open market operations are less effective, so that the central bank will choose a regime in which they won't have to rely on open market operations to begin with. And this emphasizes the role of regulatory complexity. So time's almost up, so I'll just talk a bit about other things before concluding. There, of course, the stylized model just emphasizes the efficiency of implementation and operational cost, and there are in practice many other potential considerations, some of which were kind of mentioned by other speakers in this conference, but I'll just touch briefly on two things. First is robustness of transmission to money market rates, and I'll just say that kind of the Federal Reserve's experience since QE makes it look like there is a good transmission from the administered rate IOR to money market rates, which is a good news for ample reserve supply. And for example, the Federal Reserve made a series of technical adjustments in which it changed interest and reserves without changing any other kind of parameters of policy implementation. And the Federal Reserve generally saw that overnight money market rates moved almost 1-to-1 with the change in IOR. Thus, we have a documentation of good transmission, at least based on these observations. Another benefit of ample or abundant reserves is that large scale liquidity injections will not have to come with sterilization, because liquidity injections will have little impact on interest rates. For example, in 2007, the Federal Reserve had to sterilize its own lending programs because it was still operating with a scarce reserve regime and had to control the supply of reserves. However, these days, with abundant or more than ample amount of reserves, for example, when recently standing repo facility and FEMA repo facility were being introduced, there was little concern about sterilization. To conclude, we introduced a conceptual framework to understand the change in monetary policy implementation regime with the stylized model that captures changes in the characteristics of reserve supply and demand post 2008. Thank you.
Thanks, Kyungmin. So we have the chance to have Stephen Williamson as discussant.
Okay, we okay there?
Yes.
You can hear me and see me?
Yes, it's all perfect. Thank you.
Good, okay. Okay, so I thought we'd start kind of thinking about where this floor system came from. So the first place I'm familiar with is in a paper that Marvin Goodfriend wrote in 2002 for a conference at the New York Fed, and he kind of lays out that this floor system idea and why he thinks it would be good. And basically, they're kind of two features of it he likes. One is that this argument that it makes overnight interest rate control easy. You just have to set an interest rate on reserves administratively, and then arbitrage looks after everything else. Then he says, oh, okay, and it also allows this extra dimension for monetary policy, which is, I forget what he probably calls it, balance sheet policy, but essentially he's talking about quantitative easing. So you get something extra here. And then he has this picture. So I just cut and pasted this from his article, and this is all very very familiar now. So this is like the same figure as in like figure 1 in the paper. So it's kind of derived from Poole's model, basically. So then things, it's like the Fed gets into this situation during the financial crisis where they eventually they decide they want to do large scale asset purchases, and in the course of financing the asset purchases, they got to finance the purchases with reserves, and then in that context, unless you want the policy rate to sit at zero forever, you want to be paying the interest on the reserves too. So they move up the implementation of payment of interest on reserves, and then we've got the large balance sheet. But originally the plan was that there was going to be normalization. They were going to get out of this, get away from the large balance sheet and shrink the asset portfolio and go back to go back to some sort of corridor system. But of course that doesn't happen. And by January 2019, they decided, we're not normalizing. So there's been forces within the Fed that have argued that it'd be a good idea to keep the floor system around. And then I got this quote from the FOMC's statement on this on the new regime, and they basically say that they're not they're going to do this, and I added the italics here, without they're going to do this in a regime where where active management of the supply of reserves is not required. So that's important, but I think of course part of my point here is going to be that there's a whole lot of active management of reserves going on in this system in spite of what's been said about it. And September 19, we've got this repo market incident, and which I'll talk more about later. And then this isn't a special event. This is just my opportunity to quote John Williams here. So he's still talking like in terms of what Marvin Goodfriend had in mind. He says, key benefit of this approach is a simple, effective way of controlling the federal funds rate and thereby influencing other short-term interest rates. So one of the selling points is still that this is supposed to be simple. And then, of course, by March 2020, then we're back to large-scale asset purchases, and here we are today. So the goals here. So some of this is implicit. Some of this is kind of me reading into, what's in the paper. So we, first of all, we might want to write down a more formal model of that's going to deliver that reduced form behavior that you see in this figure that we're all familiar with. And then it's kind of this is essentially going to be making a case for the floor system, a case for the policy as it was thought up and executed. There's nothing wrong with that, but it's important to understand that this is, we're not necessarily in the field of objective science or something. We're making a case for the paper's making a case for the policy. And then so there's some conclusions that are going to come from the model, and then there's some other extra stuff that's sort of like additional rationales for the floor system that come from outside the model. So an important part of this is going to be that there's part of the case is going to be that things have changed. That the world is different in important ways post-financial crisis than before, which makes which is going to support the need for this floor system. So there's one idea is there's going to be like there's higher variability in shocks to the supply of reserves. That's coming from like three places potentially. One's the demand for currency. I noticed in the talk he didn't talk about this really. It's really more the foreign repo pool and the Treasury's general account. There's a whole lot. Both of those they're larger, and the balances are more variable, and that's affecting the supply of reserves in a big way. And then the other is changes in bank regulation, Basel III rules, which include like liquidity coverage ratio and other things. Okay, so anyway, so here's the model. So it's essentially a partial equilibrium model, reserve, demand, and supply. People in this the agents in this model are banks and the central bank. That's it. And then the timing is going to be, so we're just thinking about like a regular trading day. Central bank chooses reserves R, and then there's a shock to reserve supply, which is that's S. So now there's reserves R plus S. Then the central bank intervenes. So in response to the shock, and they're going to inject X. X could be negative, depending on they're doing repos or reverse repos. So now we have R plus S plus X. And then there's a demand shock. So that's coming through the banks. There are idiosyncratic shocks to the banks, and there's an aggregate element to that shock too. Then the Fed funds market opens, market clears, and then after that, there's an idiosyncratic shock to each of the banks' reserves. Banks are indexed by I. Okay, so here's like demand side of the market. So the idea here is that the banks just like reserves. So you here in the figure on the left-hand side, that's just like a utility function. It's a piecewise linear. So it's up to that. There's this threshold where below which the reserves have some extra value in addition to the interest you get on them, and which is you could think of as a liquidity value or due to binding regulatory constraints, and then beyond that threshold, then it's your payoff just increases in linearly with the interest rate on reserves, and then because of these extra UI shocks in there, instead of just getting a step function, a step demand function, it's going to smooth itself out. And the way I drew it, it's on the right hand side. In the right hand side figure, it's I haven't got the kinks in it, so there can be kinks at where it hits either either in the left part or the right part there. So I just made it smooth.
Just to make sure that we have enough time, so there are 3 minutes left. I guess you might need 5, but please feel free to take.
Yeah, you bet. So then there's the supply side that's coming from the central bank. Basically, what the central bank cares about is variability in the interest rate and transactions cost and how big R is. And then there's this idea that the variability in the shocks is going to determine whether you're in a scarce reserves regime or this ample reserves regime. Okay, so comments here. There's this general narrative that it's kind of like it's gonna deliver these results, that the Fed's kind of always doing the right thing. The issues of there's issues with the model, first of all. So the model says, oh, things work really nicely, except for this political interference that's making reserves too low. So really, the model tells us is that you just want abundant reserves, and you want to drive the interest rate down to the interest rate on reserves. But that's not going to explain to you why we got this giant reverse repo facility take up now, which is in excess of $1 trillion every day. And there's this idea that what's happened in practice is that we've got an intervention either on one side of the market or the other side of the market. It's certainly not the case that in practice we don't have active management of the supply of reserves. There's certainly more often active management than not under this floor system, which in some sense really isn't a floor system. And there's this idea that, so what happens to interest rates in this in the model with ample reserves? You're always going to get the interest rate at the optimum above interest rate on reserves. But of course, that doesn't happen except like in 2019 when the Fed wasn't intervening. So that's an issue with the model and its predictions about interest rates and interest rate differentials. There's this idea in the paper that all these sources of variability that come post-financial crisis are kind of outside the Fed's control. The foreign repo pool, it's kind of a mysterious part of what the Fed does, but it's clearly under their control. It's not like this is something exogenous. The Treasury's account, there are ways to solve that I think without the large reserve balances outstanding. And every central bank has to solve this kind of problem. In Canada, it's kind of an integral part of daily intervention, where the bank essentially auctions government funds off in the repo market. It's like something similar could be done in the U.S. There's this financial stability issue, which maybe I won't go into that, but I don't think that's an issue here. It's like something that could be handled through the on-RRP facility. And then I'll skip sort of some of the last stuff, but there's some things that, the key things that the model's missing. There's no repo market, no assets other than reserves. It's like you kind of want treasuries in there. Doesn't include a rationale for the big balance sheet. And banks just, the banks like the reserves, and that's an assumption in the model. Model doesn't include the kind of frictions that we kind of need to explain the lack of arbitrage in overnight markets. Anyway, so the general conclusions are, this floor system that Marvin Goodfriend envisioned, it really didn't work as planned. So it's required a whole lot of intervention to make it work, which in theory it shouldn't. That's important. I think there's this issue of the benefits of the large scale asset purchases. I think that's still unclear. Maybe a lot of people would argue with me about that, but I'm not convinced. And the way ahead, I think, it has to do with, we need better models. I think Simon said this today. We need better models that can simultaneously address, whether QE is a good thing, is a bad thing, how does it work? What is it, that's inhibiting arbitrage in U.S. overnight markets, and providing good policy advice for people who make decisions about these things. Anyway, so that's it. Thank you.
Thank you, Stefan. So I think we can take questions right now. So there was, I think, one question from Lina. I just have to, so if somebody else has a question, please raise your hand. Otherwise, I'll try to find in. Okay, I think he or she isn't there anymore. So in that case, I might ask a question myself. So it's actually related to something that Stephen also mentioned. I think so. You're taking the three sources of volatility in the reserves balance as being on the same on par. So TGA account and RRP and foreign repo. But as Stephen mentioned, the foreign repo or the foreign reverse repo or the private reverse repo facility are things that are under the control of the Fed. At least the rate that you're paying on that is under the control of the Fed, especially if you price it below interest on reserves. That means that this is only going to increase at the times where you don't need reserves. So I'm wondering how you think about that.
Yeah, so I mean, I agree that there's just some degree of endogenous in the sense that the Federal Reserve just like let these things move around because it didn't have to worry about interest rate control, right? And there are safeguards or other rules of use that it can put in place to reduce their volatility. The question is like, to what level can they reduce it? Like, can it be moved all the way down to zero. I guess in principle, there's nothing prevents the Fed from doing that. But I guess it can be practically somewhat difficult, because what at least like from like my kind of understanding of how markets work is that banks are kind of now less willing to take these like large deposits from these institutions. So what happened in the past was that these institutions would put money into the balance sheets of commercial banks, and they let that happen. So that's why the volatility was really small pre-financial crisis and changes in regulations. And to just like briefly answer kind of the comments that Professor Williamson gave, I mean, these are all valid comments. Very totally agree. So I guess of course the model misses certain elements, such as for example, your comment about the interest rate being below IOR or the use of ONRP. To do that, we need some kind of element of balance sheet cost borne by commercial banks, which will can help hopefully help us model those behavior. I mean, adding treasury securities, it can be kind of more tricky. I'm not sure, and I have to think about how to do that. When it comes to repo, I guess one can think about introducing some kind of limited arbitrage between repo and like federal fund markets. I mean, it's a little tricky because doing like repo transactions, it doesn't change the supply of reserves. However, it kind of affects certain players in the market when there's market segmentation, because there are players that provide funds to both markets, and then they can arbitrage. So there are some, I guess, machineries that we can introduce, but of course that'll complicate the model quite significantly.
Okay, thanks, Kyungmin. I don't see any further question. If there is any pressing one, please raise your hand now. Otherwise, we are going to move to the next session. And next session is a paper presented by William Diamond. So William, please feel free to share screen and take over.
Thank you so much for including the paper on the program. Very interested in getting your feedback and Sebastian's comments as discussants. This is called the Reserve Supply Channel of Unconventional Monetary Policy. And we're interested in the specific fact that one aspect of quantitative easing is creating this large supply of reserves that live on bank balance sheets. So QE has been one of the main responses of central banks in crises recently. There's conventional monetary policy till you hit an interest rate of 0. Beyond that, you buy long-term bonds to push down longer rates. But there's this separate consequence, which I don't think was directly the goal of QE, but it created this large supply of bank reserves, which are short-term liquid assets that specifically have to be held on bank balance sheets. And they tended to pay a higher interest rate than similar short-term maturity liquid assets available to non-bank investors. I think the maximum spread came to about 15 basis points or so. And the question this paper is asking is, what is the impact of this, you might call it unintended consequence or secondary channel of monetary transmission through QE, of putting trillions of dollars onto bank balance sheets of these reserves that only banks can hold on the rest of what banks do? How does their lending affect it? How does their deposit creation affect it? And the main thing that we find in this paper is that for every dollar of reserves created by QE, 13 cents of lending by banks to firms is crowded out. Now, we look at other possible ways the bank could adjust. We're not writing a paper specifically about lending to firms, but once you go through our approach, that is where the quantitatively large result is. And the way we're going to answer this question is using a structural model of the supply and demand for bank borrowing and lending, which we're going to try to estimate entirely using cross-sectional instruments. So QE itself is not a natural experiment. We want to use variation, which we do think is relatively exogenous, to identify our model. once it's estimated off of cross-sectional variation using different bank branches in different regions of the country, we're going to simulate a counterfactual of flooding the model with reserves like in QE and see what happens given our estimated parameters. So in theory, flooding bank balance sheets with reserves could either make lending go up or down. Crowding in or crowding out is one way of putting it. And there's this old view of the role of reserves back in the days, particularly of binding reserve requirements, where reserves are a scarce liquid asset that banks need to settle their sort of intraday liquidity positions. Let's say there's a quick withdrawal from one bank. Maybe they can redeem reserves in order to pay out the depositors who are withdrawing their money, and it settles these sort of intraday liquidity needs. If that's the case, then if there's a scarcity of reserves, you might be able to hold more illiquid assets and scale up your balance sheet once the scarcity is reduced. Conversely, if reserves are not a particularly special asset to banks, suppose that their demand for reserves is more or less satiated, then in a world where it's costly for banks to expand their balance sheet, making them hold more of one asset will naturally make them want to hold less of another. And this is how some recent intermediary asset pricing models tend to behave, such as Hyun Krishnamurthy. And this paper by Dutepper and Vetterlhan shows evidence that some specific bank regulations, such as the supplementary leverage ratio, are crucial for this to be important. But nevertheless, theoretically, this could go either way, motivates our empirical approach of actually trying to quantify this, and we end up ending with the crowd out result that 13 cents of lending to firms goes away for every dollar of reserves that banks have to hold. So here is a naive plot, which is not a form of causal inference, but I view as a form of motivation, that reserve balances were very small before QE started. As QE is implemented, reserves go up into the multiple trillions of dollars. And then in 2020, with the COVID response, that's sort of a new wave of QE, they reach an all-time high. And the other line we're plotting is the fraction of banks' assets, which we're calling illiquid assets. This is everything except reserves, treasuries, repo, sort of cash-like assets, that fraction reduces as banks have more and more reserves injected into the system, which loosely is evidence, you could say, maybe that reserves could be crowding out banks' holding of other assets. Now, making two time series on a plot is not, to me, a form of causal inference. So you might say, well, what's really going on here is QE is a response to severe recessions. What you're just picking up on with the rest of banks' behavior is what they do in a severe recession, the policy response not being what's directly causing the observed data in the time series. This motivates our structural approach, where we're going to try to use a model which is relatively simple, just supply and demand, which will allow us to use variation that we do think is more exogenous, not directly caused by QE, but using cross-sectional shocks in different regions of the country in the bank branch network, to identify the parameters of our model, which will then allow us to simulate QE, this reserve injection component of it in particular, as a counterfactual. So we estimate the model in the cross-section with our parameters, we flood the model with trillions of dollars of created reserves, and then we look at the new equilibrium, and that is our effective QE implied by the model. All right, so the finding is this reserve supply channel of QE. Just to be clear, this other effects of QE of reducing the supply of treasuries, pushing down the term structure of interest rates, that's sort of not in our model. We have no quibble with that channel being important as well, and that was sort of the intended transmission mechanism. But the secondary effect of forcing reserves to specifically live on bank balance sheets, we think we're one of the first papers to emphasize. And what we're finding here is by making banks hold trillions of one asset, we're crowding out their supply of lending to the real economy. Another asset they might hold would be loans to firms. Deposit and mortgage quantities are effectively unchanged. They're allowed to change in the model, but we find that the demand system says there's considerably more elastic demand for bank loans than there is for mortgages and deposits. So a similar change in interest rates leads to a considerably larger change in quantities for the bank loan side of the portfolio rather than the mortgage side or the deposit side. So with our model, we run this counterfactual where we put in enough reserves to generate a 15 basis point increase in our rate. Think of that as like the 15 basis point spread between the interest on reserves and the Fed funds rates, which is a rate available to non-bank investors. About a third of this passes through, or a little bit more, to deposit and loan rates. Similar across all parts of the market, but because the bank loan demand is so much more rate elastic, that is where we see the quantity response. And what's crucial here is that only banks can hold these reserves effectively by regulatory fiat. And we say that it's costly for banks to adjust their balance sheet. They can't just add these to their balance sheet, issue a bunch of deposits, and sort of pass it through costlessly. And that's why we're finding these real effects on bank lending. So there's a bunch of other papers that have channels of QE transmission about asset markets, about bank balance sheets, but they focus more on the asset that's purchased rather than the flooding of reserves that banks have to hold. There's a theoretical literature we're very related to about the synergies on bank balance sheets. We're the first to quantify this structurally in our model, and that's crucial for our results. If you hold more liquid reserves, what does that do to your cost of providing deposits and providing loans? Theoretically, people talk about these synergies a lot. That's why banks exist, bundling deposits and loans together rather than two separate firms doing each individual business line. But we're the first to quantify that. And then related to the structural literature, we made a big effort to get cross-sectional data where we can see the same bank interacting in multiple branches across regions of the country, and that's crucial for our identification approach. All right, so I'm going to show you the model. This is probably the most important slide for me to go slow on, so I'll spend a little bit of time here. Basically, the model is supply and demand, except that banks supply multiple things: deposits, loans, and mortgages. So each bank is going to have a residual demand curve after it competes with everyone else in the market. So everybody's interest rate, all the banks will choose, let's say, a bank loan rate. Your competitors, their rates will affect your business quantities because they can steal business from you. But holding all of that fixed, you still have a downward sloping demand curve where the interest rate you pay determines how many people want to take loans out from you. In addition to this, we're having what we're calling, sort of in quotes, a liquidity cost function. This captures these synergies on bank balance sheets where issuing deposits makes it cheaper to provide loans and so on. This is a reduced form function, which we're just going to quantify in the data, which will tell us, in particular for the QE counterfactual, how does flooding the bank balance sheet with reserves, that's these liquid securities S, affect their cost of providing traditional things like loans, deposits, and mortgages. And what the bank is going to maximize is a standard one-period profit function of the interest rate it either pays or charges for loans and deposits, minus a fair discount rate for that stream of cash flow. So this spread is effectively how much profit they're making. If this is, they're getting to pay 20 basis points less interest than the loan is actually valued to them, is their sort of discounted value of cash flows, that profit times the quantity is the total profit from lending. So we add up sort of profit per unit or markup times quantity as a total profit in each line of business minus this total cost function. And that's what banks are going to maximize. And they have their first order condition, as you always do in imperfectly competitive markets, that marginal cost equals marginal revenue. So the marginal revenue of additional loans from changing your loan interest rate equals the marginal cost in terms of this liquidity cost function of holding that on your balance sheet. For reserves and liquid securities, that's a competitive market. So we just have marginal cost equals marginal benefit with no market power involved. Here's the model in a picture. Marginal cost equals marginal revenue sets the equilibrium interest rate. So that's the intersection of the blue curve and the red line. And then we plug that back in the demand curve to get the equilibrium quantity. Let's shock this. Let's say we flood the market with reserves, which shifts the bank's cost of providing loans. That's going to drag along the marginal revenue curve to a new intersection of marginal cost and marginal revenue. That's going to be the new equilibrium interest rate. We're going to plug that back into the demand curve to get a new equilibrium quantity lended. So that is how the price and quantity of loans responds when you flood the market with reserves and change the bank's cost of capital for lending. And this also tells you what you really need to identify in the model. You need to figure out these demand and marginal revenue curves. That's the demand side of the model. And you have to know how much did that red marginal cost line shift? How much is the bank's cost of providing loans impacted by flooding the market with its reserves, like is done in QE? And this is a standard supply and demand framework. To estimate demand, you need an instrument for supply. To estimate supply, you need an instrument for demand, except the banks provide multiple things, deposits, loans, and mortgages. We're going to need multiple instruments to estimate the supply side of the model. So we have branch level data for deposits and mortgages, and then state level data for loans from HMDA, DealScan, and RateWatch, all in FDIC. So we're going to merge together this rich micro data set, richer than a bank level, on the skeleton of the bank level call reports data to integrate this into a unified whole. So to estimate our demand curves, we need these shocks to supply. And we're going to use something from the reduced form literature, following a paper by Cordes and Strahan, looking at natural disasters. So what they demonstrate is, let's say there's a hurricane in a region, everybody's house gets damaged and they want to borrow to fix up their house, do some home repair. Banks are going to reallocate funds from the rest of the country in order to meet that lending demand increase. So where the disaster occurs is not a shock to supply, but as banks reallocate funds across their branch network, other branches of the same bank, which were not hit by the disaster, are having a reduction in lending supply there as the bank reallocates to meet this disaster demand. And the identification assumption is, if you're not in one of the disaster counties, you are not getting a direct supply shock from the disaster somewhere else. It's only going through the response to the banks reallocating funds. So we're going to estimate a logit demand system. I can go through the IO details if you're interested offline, but this implies that banks' quantities lended in each market is log linear in the interest rates they pay. This can be estimated with a linear two-stage least squares approach. So we're going to run this two-stage least squares regression, use the disaster reallocation shock to change the supply of each bank. That affects the interest rate they pay. And then we see how the deposit or loan quantities respond to that exogenous shock to the interest rate to estimate the slope of the demand. So we find that for each bank, if they change their rates by 10 basis points, that leads to a 4.6% increase in their deposit market quantities and just over a 50% decrease in their loan and mortgage quantities. So for an individual bank, the mortgage and loan demand systems are highly elastic. For deposits, less so. But this is identified by looking at differences in quantities affected by differences in rates. There's a separate aggregate elasticity we care about too. So in the paper, we show how to aggregate our instrument up to a market level shock to say exogenously, if collectively the whole banking system changes their loan rates, how does the whole loan quantity respond and so on. And what we find is that when an individual bank adjusts their rates, 29% of their new business for deposits is coming from outside of the market rather than stolen from competitors. For mortgages, that's only 8%, which makes the aggregate mortgage demand curve not particularly elastic. And for corporate loans, we have about 40% there. So the corporate loan demand curve at an aggregate level is by far the most elastic, and that's crucial for our results. That's why the quantities respond there. All right, that's the demand side of the model. Now I have to show you how flooding the system with reserves changes the bank's cost of lending. And what we're going to do is we're going to take the demand side. This gives us a realized estimate of the bank's marginal revenue of providing loans, deposits, and mortgages. Marginal revenue equals marginal cost when you're optimizing in an imperfectly competitive market. So that effectively gives us data on the bank's marginal cost of providing loans, deposits, and mortgages. So what we're going to do now is see how that realized marginal cost responds when we shock the composition of the bank's balance sheet. The bank has multiple things on its balance sheet: loans, deposits, mortgages, securities. These are all endogenously responding to shocks, so we need multiple instruments for identification at this point. So basically what we're going to do is, for each of our instruments, we're going to reuse the disaster shock, and then we're also going to use a deposit demand shock based on regions where deposit quantities have grown. If you happen to have branches there, we consider that a shock to your deposit demand because you didn't cause the regional growth, presumably. And what we do for each of these instruments is regress your marginal cost in this example of providing deposits on the instrument, regress all of your balance sheet quantities on that shock as well. And then we learn that collectively, these four quantity changes of securities, that's reserves, liquid securities, loans, mortgages, and deposits, collectively cause the observed change in the marginal cost of providing deposits. Now, this is an equation where multiple unknowns can, determine this. Is it the deposit quantity that affected the cost of providing deposits, or is it the mortgage quantity that affected the cost of providing deposits? So we're going to set up a system of equations. Each of these regressions provides one thing our cost function has to satisfy, and we're going to pick the parameters of the cost function to collectively match all of these reduced form IV regressions. So this is expanding the usual intuition that as you shock demand, you can trace out a supply curve in a one good supply and demand market. What we're doing here is multiple demand shocks for the multiple goods that banks provide. Jointly, you have to match all of that to determine what the cost function is. And this is going to crucially give us the most important estimate, which is what is the cost response of being flooded with reserves? If you put a bunch of reserves on banks' balance sheets, how does their deposit, mortgage, and loan costs respond? And these numbers here, to interpret them, let's say we put 1 trillion of reserves into the system, divided equally across all the bank branches in 2007, that's going to give you 184 million per branch in our data set. Multiply that by the parameter in this matrix to get the resulting effect on marginal cost. So you get about a 3.73 basis point drop in the marginal benefit of holding securities for every trillion in reserves. And that's roughly where you get this idea that a few trillion is what's needed to match the observed 10 to 15 basis point spread. And we get a drop in the cost of providing deposits, an increase in the cost of providing mortgages and loans. And you also get this natural synergy everybody assumes about banking, that holding deposits makes it cheaper to provide loans and mortgages, and conversely. So we're passing the check that yes, banks actually should exist in the way that all the theory models expect them to. But once we have these supply and demand estimates, the last thing we can do is run a counterfactual. So we're going to add a bunch of reserves to the market. 4.76 trillion is the number in the benchmark. That's enough to get a 15 basis point increase in this IOER rate above the Fed funds rate. And then we're going to re-clear the whole market. Banks can trade these reserves with each other and re-optimize all of the loans they pay and charge for loans and deposits in their various markets. And we're going to compute the new equilibrium, clearing the market with this larger reserve quantity. And that's how we think of the effect of flooding the system with reserves, what that does to the pass-through to the real economy. And what we do after computing this is we find that of the 15 basis point increase in the reserve rate relative to Fed funds, roughly a third passes through to deposits, loans, and mortgages, 6 basis points, 5 basis points, 4 basis points. But when you look at the quantities, because I found that the loan demand system is so price elastic, we get about a $550 billion drop in loan quantities to firms. This is in these syndicated loans, is the data set we're estimating this. The deposits and mortgages quantitatively much smaller because the aggregate elasticity of demand there is just not the same. These rate changes don't lead to large changes in quantities. So to summarize, this paper has this new reserve supply channel of QE transmission, which we've identified by estimating the structural model. We use cross-sectional variation or across different regions of the country to construct these instruments for the supply shocks and demand shocks needed to collectively estimate this supply and demand model of the banking industry. Then we flood the system with reserves, compute a new equilibrium of the model, and find that 13 cents of bank lending to firms is crowded out for every dollar of created reserves. If you want to think about some potential policy solutions to this, you might think that allowing non-banks to hold reserves or expanding the reverse repo facility, maybe a central bank digital currency would be one approach. Get the reserves out of the banking system, and you can still have the rest of the QE transmission without locking all this onto bank balance sheets, or relax maybe the bank supplementary leverage regulation, in particular into its treatment of reserves, and that would get around this unintended consequence as well. Thanks for listening, and I look forward to Sebastian's comments.
Thanks for indeed the discussion from Sebastian Infante from the Federal Reserve Board.
So I hope everybody can see my slides.
Yes.
Yeah, perfect.
Great. All right. Well, thanks to Quentin and the rest of the conference organizers for giving me the chance to talk about this, discuss this really interesting paper on sort of reserve on a sort of a new channel of which unconventional monetary policy may act, which is through the quantity of reserves. Now, before I begin, I must say I'm affiliated with the Federal Reserve Board, so especially for the subject matter, it's important to recognize that these are just my views. They don't reflect the views of anybody else. Yeah, if anybody has any quibble with it, just talk to me about it. All right. So, what is the main motivation of the paper? Well, it comes from this idea that this question is, how does the expansion of reserves through quantitative easing affect banks' ability or willingness to provide bank services? And this is what the authors call the reserve channel. And so the main premise is that as a central bank purchases securities, it's increasing the amount of reserves in the system. That naturally is going to translate into increase in the individual bank size. And this could potentially alter banks' operating costs and therefore affect the way that they actually interact with the rest of the economy. So as Will said, in principle, this could go either way. So it could actually increase the provision of bank services in the sense that more reserves makes a bank better to sustain liquidity shocks. It's better to supplant bad liquidity conditions, and therefore it would be more comfortable in engaging more loans and taking on more deposits. Or conversely, you could think that, because of some sort of regulatory constraint, and there's a particular emphasis in this paper, the supplementary leverage ratio, you could have that this increase in reserves is going to increase the size of banks, and it's going to effectively increasing their cost to operate, and this is what is going to actually cut back on the services that they provide. So the specific services that the paper analyzes are to provide loans and mortgages and receive deposits. I put those in red. This is just a small pet peeve comment, but in the paper, it's all like provide loans, mortgages, and deposits. In my mind, I think it's good to kind of separate it because there's something different kind of going on, but that's not a big comment. Just my own pet peeve. So what is so obviously this is incredibly challenging, right? How are you going to disentangle demand and supply? So the paper proposed a structural model in an environment where banks compete imperfectly to provide these services, and they're going to measure the sensitivities exploiting the cross section. So we'll explain this very well, and I cannot do justice. It's a very high-tech paper, so I'll just talk about the figures that he showed. Step one, estimating loan demand curve, which is effectively using an instrument of natural disasters to try to back out what this elasticity is in the green line. And therefore, once we have that, we can think about what, in the second step, using these measures, how would the potential marginal cost change with a balance sheet adjustment? And obviously the one that we're interested in, an increase in supply, which would put outward pressure on this, on the lending, marginal lending, and therefore you would get the new equilibrium, right? And so the headlines result is QE crowds out bank lending, right? And in particular, in their counterfactual exercise, they do an exercise where a $4.25 trillion increase leads to about a $500 billion decrease in lending. Now, this is huge. There's also very interesting firm level estimates of sensitivity. As Will said, much of this bang of the big sensitivity of loan demand really comes from this estimate of the elasticity of loan demand, which is a 10-bit increase in loan rates will a decrease in loan demand, a 22% decrease in loan demand. And also the sensitivity of the cost side is also interesting. And so effectively the punchline is QE can significantly affect banks' provision of services. Now, again, one thing that I'm going to note is that the counterfactual, where does this $4.25 trillion number come? It's from this counterfactual analysis in which the authors pump reserves into the system to try to get a widening of what they interpret in their models, the IOER Fed funds spread. I'm going to talk a little bit more of that later. And there's also an effect on mortgages and deposits, but these are much smaller because in large part, the elasticities measured in the demand system. So overall, this is an incredibly interesting mechanism. It's a very impressive strategy, above my pay grade. I can't do this. This is very, very high tech, and I really applaud the authors for taking on such an ambitious project. And it's also quite controversial, not just so much because of what we typically think that QE is supposed to promote lending, because of the price mechanism that Will just briefly mentioned, but also there is literature that has found quite the opposite sensitivity by colleagues of the board, John Kendrick and Bernard Schulze, who find using an experiment of changing FDIC, they actually find the opposite. So in the version of the paper that I read, this paper wasn't cited, but I see that in the slides that they were. So maybe a discussion on what's going on and try to square these two results. As I said, the individual bank level, the marginal banks, these are impressive and quite insightful. This elasticity of loan demand is really, really impressive. It's huge, and it kind of drives a lot of the big response. So for today's discussion, I'm going to have to apologize to Will. I'm not going to give any insightful technicality like you could have done this, you could have done the other. really, I'm just going to pose a series of questions, and these questions, some of them will be very easy to answer, some of them perhaps a little bit harder. But really, what I want to get at is to this headline number. This, I think we'll talk about it differently. $1 increase leads to a 13-cent decrease in loans. That headline number, I think, is the best part of the paper and most controversial, and sort of all my comments are going to be geared at sort of trying to make that a little bit more convincing and maybe robust. So one is to unpack the effect of QE on balance sheets, the other importance of the SLR, and finally, the monetary policy framework. So I probably don't have to go over this for this audience, but let's just unpack how this actually happens. I have three stylized balance sheets. On the far left, we have a non-bank entity. On the far right, we have the central bank. Non-bank entity has an amount of securities. It's going to drop by $1, and it's going to get deposits in change. And so how does this actually happen? Well, the Federal Reserve gets the security. It creates more reserves. These reserves go into the bank of this non-bank entity, who increases the amount of deposits, right? Very simple. So from this very simple illustration, you see, right, Federal Reserve buys securities, central bank balance sheet, individual bank balance sheet is going to increase. But the first question I had is, what if the banking sector is selling directly to the Fed? Well, obviously, under this stylized framework, there's no impact at all on the size. And sort of, I was wondering, is this sort of a relevant thing? And so I didn't have access to the data, and so I asked a colleague, Camelia Minoyu, at the Fed, if she could give it to me, and sort of she was readily available to give me all these data, which was absolutely fantastic. So just a side note, any PhD students in the audience, this is what the upside of the Fed, working at the Fed, can do. You just pick up the phone and somebody will send you these cool data sets. So anyway, that's a little bit of marketing on my side. But here what I've done is I calculate the ratio of the total securities of relative to assets, and I do it with reserves, treasuries, and agency MBS. And the first thing that you realize, obviously, is that the reserve number goes up. So this is the fraction average across all firms, right? Reserves go up, the fraction of treasuries goes down, right? And then you have this, this final pickup through COVID, and it's somewhat a smaller, less obvious pattern for agency MBS, but there does seem to be at least a little bit of substitution between these two. And I'm just wondering, how important might this be quantitatively? So my first question is, can we account for banks selling directly to the Fed? And more importantly, for the headline result, will this significantly change the estimate of the aggregate impact on the counterfactual? So the one extreme of the paper is that it's all coming from non-banks. The other extreme, it's all coming from banks and nothing happens. So, where are we really in this spectrum? And so that would be that'll be good to clarify. And somewhat relatedly is sort of, does the distribution of these reserves actually matter? And I think the answer is yes. So what I've done here is the red line and the blue line are the same as before, but here the red dash and blue dash are effectively, I just add up the total amount of treasuries, add up the total amount of assets, and take the ratio. So this is the ratio of the total, right? And so yesterday, in yesterday's talks and a little bit today, there was a big emphasis on sort of the role of large players. So Daryl Duffy, he had that finding that like the top 10, the opening of the reserve balance of the top 10 largest repo active dealer banks were really responsible for all of the disruptions, or all the changes in interest rates. And so I think there is a lot of evidence to think that this distribution matters and how to think about bank activity. So my next question is, do the estimates change if we exclude subsidiaries of bank holding companies with large broker dealers? Now, I think probably not, because you're doing this individual elasticity estimation. But I think more importantly, for the counterfactual analysis, can you exclude these firms? I mean, it seems that if it is true that the JP Morgans and Morgan Stanleys of the world are taking all these reserves, then sort of what does this actually translate into individual bank branches? And sort of, I don't know if the model can deal with this in the estimation, but I think certainly in the counterfactual analysis, we can postulate different sort of take-ups of different types of agents and see if this really does have a large impact. So the other issue I wanted to raise was sort of the importance of the SLR. And to be clear, in the paper, in the estimation, the bank costs are reduced forms, and the authors just talk about the SLR really just as a form of a motivation, right? And the main motivation is that, right, holding equity fixed, a restriction like the SLR is effectively just a restriction on the overall size. Now, don't get me wrong, I'm not a fan of the SLR, especially since, I think in 2013, I first heard Darrell Duffy, criticize the SLR in the context of treasuries. But the question I raised, is this completely relevant for this context? So just to be clear, the timeline of the SLR rule is as follows. In 2010, there was the introduction of the idea of a tier 1 leverage ratio in the Basel III framework. 2013, agencies posted a notice of proposal rulemaker for the leverage ratio. 2014, the final rule was adopted. 2018, it was a requirement. And then there was an exclusion post-COVID, and the sample period of the paper is 2001 to 2017. So it seems that at least in terms of a timeline, that I know banks try to front run regulations and so on and so forth, but at least in terms of a timeline, there seems to be a little bit of a disconnect, which, I don't think that is a big issue. But I think what could be a little bit more important to think about is that the SLR rule is at the BHC level, and it's at the aggregate bank holding company level. And these estimates, these sensitivities are at the individual branch and bank level. And so the two things are, first of all, this restriction seems to be much more relevant for the larger players. Think about the enhanced supplementary ratio, which is the additional leverage charge for large banks. But then how does this sort of holdco restriction actually affect the individual branch that you may be thinking about? And so, as I said, this is just an issue of motivation. The paper doesn't need to take a stand on this, but it would be good, and especially at the end, that sort of Will's final slide, it was a policy proposal, like revisiting the SLR. Again, I'm all for rethinking the SLR. That's, that personal preference. These are my views. But is this the most relevant, restriction for this paper? And maybe there could be other things that the authors could mention that would be more in line with what they're trying to measure. And the final one, I would be remiss in a conference like this not to talk about the operating framework. We've seen a bunch of papers in which, they've talked about the different worlds in scarcity and ample supply of reserves. And I was really surprised to see that the paper really didn't talk much about this, right? And so, I don't have to remind it. Kyungmin did a really good job to sort of talk about this in the previous presentation. In pre-2008, there was reserve scarcity, in which the banking sector as a whole would make the Fed funds market clear, and that would be sort of the interest rate, the Fed funds rate. Post-2008, there was interest actually paid on reserves. So before, you wouldn't get anything for reserves. Now you get paid on reserves. And after a certain point, quantities are actually pretty irrelevant. And so if you think about sort of one target spread that the paper does for its counterfactual analysis, IOER Fed funds spread, which some people sometimes call the Fed arb. And really, that's not attributed to, that's really attributed to one group of agents, with their GSEs. So GSEs and some other types of firms, types of entities rather, do have access to reserves. However, they don't get IOER, right? And so obviously, these are the guys that are going to be lending to the banks. Banks in flood reserves don't really need this stuff, the large ones. So they're just going to borrow, and the bank's going to pocket the spread. And so keeping that in mind, that's actually what's going on in the data, sort of this sort of game between reserve holders that get IOER and reserve holders that don't. I was a little confused with the counterfactual analysis. I wrote Will about this a few days ago, and he did clarify it a little bit, and I didn't change my slides, so this is a little unfair. But there was a statement sort of in the paper that we posit an increase in R on interest paid on securities, then compute the quantity of reserves a central bank must add in the financial system to increase this interest rate. And sort of they're talking about the Fed funds IOER spread. So how does this increase in reserves affect the actual IOER Fed funds spread? I'm not proposing you put this into the model or anything, but I do think that it would be important to clarify whether the monetary policy framework has changed bank costs. I think it's reasonable to assume it has. The previous paper was somehow all about that effectively you're in a different regime, so banks optimization is going to change. And So maybe one suggestion is, can you change the estimates in the sample period of 2001, 2008? I don't think, again, that's going to change anything. We're looking at individual firm level elasticity, so I don't think much is going to change. But then when you aggregate up, there could be something different. It would be interesting to know. And secondly, could there be a little bit of a discussion of other central bank facilities? What is the overnight RRP playing? The previous discussant had mentioned that, with all overnight RRP, if overnight RRP is very large, then, quantity reserves is going to mechanically go down. And maybe this is something that we want, and sort of just discussing these other facilities and the framework just more in general, I think would make the argument much more robust and sort of easier to digest to see if these things matter really. So just with those points, I'll wrap up. As I said, it's an incredibly interesting paper. It's very ambitious because doing these IO stuff at the bank level, I can't even imagine how hard that's got to be. And there's a lot of bells and whistles to take care of. The authors do a really great job. It's very policy relevant. But I think if the headline number is something that you would want somebody in board staff to actually communicate to principals, I think it would be good to clarify these. Perhaps some may view actual microstructure dynamics between firms and interaction with the Federal Reserve. That would be important to clarify. So those are the effect of QE, the real importance of SLR, and sort of thinking a little bit more about the monetary policy framework. So I really look forward to the next version of this paper. And again, thanks for letting me the opportunity to talk about it. It was very, very cool. I learned a lot. Thanks.
Thanks, Sebastian, for the discussion. So I think we can collect a couple of questions, and I'm going to start with mine because I don't see any hands raised. So I think you could have called this paper basically the reversal quantity of reserves or something like that. It seems like you have this trade-off, and arguably, usually you think you are in this other world that looks like a pool 1968 model where when you add up reserves in the system, it's a net positive and you don't have any issue. But then now that we know that balance sheet space is costly, there's this potential for crowding out that comes in. And so I think what would be interesting is to try to actually write on that model that has this continuity from what people traditionally have in mind. I don't know if it's for this paper or for another one, and then also something that's not super clear is what happens when you reach this reversal quantity. Like, do you instantaneously jump up to 13 cents on the dollar and then you stay there for the whole time? Or is it like convex or concave, or you have some increasing trends? And so that's probably important for interpreting your results as well. So that's what I was thinking. Something else I was thinking. So if you are it's in terms of interpretation. If you are interpreting what happens on the loan side, I think it's probably still important to understand what's happening on the asset side of the balance sheet of the central bank, because what happens that the central bank actually buys a bunch of loans, securitized loans, and put it on its own balance sheet. So even if the banks are not reacting by replacing these loans one-to-one, the fact that the Fed has actually bought a bunch of loans on the other side is going to have a matter a lot for quantities and also probably for pricing. And I don't know, I get the idea that you can separate the two conceptually, but maybe when it comes to interpretation, you have to keep that in mind. So these were my two comments. And I don't know if there are other questions. Maybe you can take another one. And if not, feel free to.
I guess I'll go ahead and answer quickly.
Yeah.
Hey, thank you very much for the discussion, Sebastian. All these institutional details, I agree, we should discuss quite a bit better. And I guess relatively similar response to both of you in many things that conceptually, yes, we do want to do a lot of these things of, taking the institutional details more seriously, thinking about, convexity and concavity. In a counterfactual, we could, plug some of those things in, not estimated, and that could be quite interesting. In terms of what the data can tell us, we were, rather aggressive with our modeling approach of wanting to make this come down to using linear instrumental variables regressions as our, building block for identifying the model. And that means that naturally a lot of things, when you expand them out, are our local shocks, relatively small, which we observe in the data, are going to be, when you do a big counterfactual, assumed to be, sort of this extrapolate linearly to some degree. So yeah, I guess about the comment of the asset side of QE2, we agree totally. We're not saying that QE in net causes a reduction in bank lending. I think maybe one of the easiest ways to interpret our counterfactual is do exactly the same QE policy as you would, except relax this idea that only the banks must hold the reserve. So you buy a few trillion in assets and you create a few trillion in short-term liquid assets, which are maybe T-bills, which anybody can hold instead of reserves. And that specific difference, I think, is what our model is zooming in on. Because I mean, there is no term structure of interest rates in the framework in the first place. And I think any kind of reasonable general equilibrium model will have, if you have a Keynesian demand shortage, you push down rates, people borrow and consume more. That's likely still the first order effect. We're just saying something about the implementation structure, that forcing this to live on bank balance sheets has this, unintended consequence that might be contractionary.
Can I ask just a follow-up here? So, and the main difference that the non-banks are not subject to SLR.
Yes.
That's what you have in mind?
Yeah.
There could still be some substitution happening, but
absolutely.
Yeah, okay.
And in terms of interpreting our results, it's potentially a lot of this is substitution, because our loan quantity reduction, this is coming from a syndicated loan data set. That's probably the most elastic segment of the market. That could be CLOs stepping in to provide bank loans. That could be firms substituting to the bond market instead. I mean, we sort of went as far as we could in terms of what the data can answer, but you could say there's an aggregate reduction in bank loans, or sort of loans to firms broadly defined. You could just say instead what's going on is, by fiat, we forced one type of asset to live in the banking system. So we found ways to sort of zigzag everything else out of the banking system, but with some sort of cost going on in the process. And I guess this also gets to Sebastian's point about the, implementation framework, where I think as long as you have, an equilibrium clearing at the old market, where let's say you have non-banks want to invest in the Fed funds rate, they like getting interest there. That net demand, if that's sort of held relatively fixed, as long as sort of the slope of the supply curve from banks is as we've estimated it, I think the counterfactual is invariant to that. So let's say there's a fixed, 3 trillion in demand for Fed funds from non-bank investors. As long as that stays constant, everything else will be identical. If that shifts as well in the counterfactual, then which is sort of something our data can't tell us about, then things could change. And similarly for the treasury substitution, if you can give us a fraction of treasuries crowded out, we can put that in and just make the counterfactual a little bit smaller. If we have to estimate that number, our data would find it very difficult to actually tell us that. I can sort of explain that offline. We beat our head against that one for a while and decided it was very hard. But yeah, sort of naively from your plot, maybe 10, 15% or something of the reserves is a reduction in treasury holdings. That might also be primarily from the biggest banks, and the biggest banks are a little bit different from most of our sample. We've got the depository institutions here in our data set. The BHCs are kind of already broken down with the dealers thrown out. So I think that comment is sort of already how we're treating the data, but I'm happy to discuss more if you have thoughts different from what we're actually doing.
Okay, great. So I think we went over a little bit, but the discussion was definitely worth it. So thanks a lot for all of the presentation to everyone that participated today. So as yesterday, I'm going to send now in the link, in the chat, a new link. And that's basically, if you want to prolong the discussion a little bit with us, feel free to join there.